Yes, a very good morning, guys. Can you please confirm in the chat if my voice is clearly audible to you guys and you are able to see the screen? Can you please quickly confirm? Okay. So first, let me introduce myself. I am your second teacher who will be taking some of your classes for this crash course. My name is Shubham Swaraj. I'm the co-instructor here for FRM Part 1. Okay, so this is the second class for FMP, that is Financial Market and Products. And in today's session, our objective is, uh, uh, Ritman, I would say, please confirm with our team over Telegram or WhatsApp. They will tell you when the PPTs and all will be uploaded or anything regarding that, because I personally don't have any clear information on this. Okay, so yeah, now today what our agenda is, we will be covering options in detail. Okay, so let me tell you very clearly, there is a slight change in the plan. So you see, if I talk about options, there are 4 chapters of options that we have in financial market and products. And then you have 3 chapters related to options. Those are in valuation and risk models. Okay, so in financial market and products, the chapters are FMP 12, 13, 14, and 15. Okay, and in valuation and risk models, the chapters are 14, 15, and 16. That is binomial trees, Black-Scholes-Merton option pricing model, and the Greeks. Okay, so in today's session, we'll be covering this topic, options, inside out. We'll start with FMP 12. We'll go up to FMP 15. That is our exotic options. And then we'll move to option modeling, option price modeling, that is binomial trees, Black-Scholes-Merton model, and finally the risk measures associated with options. Okay, so let's start our session without wasting any time. So first, we'll cover FMP 12, that is options market. Now, if we talk about options, so basically options can be divided into 2 broad categories. Okay, first one is call option, where the buyer of the option gets the right. Okay, the buyer of the option gets the right to buy the underlying asset. Okay, that's the difference. So you buy an option and that gives you a right to buy the underlying asset. Second is the put option, where the buyer of the option, or the buyer of the put option, in other words, you can say the long position in put option, allows you to sell the underlying asset at a predetermined prices. Okay, now if we talk about call and put option, they can further be classified into 2 broad categories, another 2 categories, and these are American style option, and then you have European style option. Now, if I talk about American style options are those options which can be exercised on or before maturity. That means it can be, let's say there is a call option which is expiring in 3 months. So you can expire it exactly at 3 months from now, or on any date before 3-month period. From today till the next 3 months, you can exercise it at any point of time. That's the liberty that you get in the case of American style option, be it call or put option. Next, we have European style option, which can only be exercised at the maturity. So if it's a 3-month put option and it's a European style option, so you can exercise it at 3 months from now and not before that. Okay, not even 1 day before that, only exactly at 3 months from now. And practically in real life scenario, it happens exactly on the third Saturday of the third Friday of the 3rd month, if it's a 3-month call option. Okay. Now, next important thing that we need to understand about options is the moneyness. Moneyness can be of 3 types: in the money, at the money, out of the money. In some literature, you may also find 2 more extra categories, that is deep in the money and deep out of the money. But that's nothing different than in the money or out of the money, because in the money and out of the money are the general definitions. So let's understand what these definitions are. So first, if you have an option that gives a positive payoff if exercised today. Now, you might wonder that, okay, if it's a European style option, I cannot exercise it at any point of time. So in that case, you just imagine that it's a hypothetical exercise. Okay, you are exercising it in your mind, not in reality. And then you compare that, what is this payoff? If this payoff is positive, okay, then the option is considered in the money. And for call option and put option, positive payoff are in the different scenarios. And these are for call when the asset price, underlying asset price, is greater than the strike price. So if let's say strike price is 50 and asset price is 60. Okay, so asset price is greater than the strike price in this case, and we call the option in the money, call option in the money. For put option, it's just the reverse, where asset price has to be less than the strike price. We call the option in the money. For at the money, for out of the money, the scenario is for call option, the payoff should be, for any option, in fact, the payoff should be negative. hypothetically you exercise it in your mind that imagine, okay, if I exercise it today, what will I receive? Will I have a positive payoff? Like for call option, the payoff formula is S minus K, right? ST minus K, you can say that. So is ST minus K positive or negative? You have to see that for call option. If it's negative, it's out of the money. And that is the scenario when S is less than K for call, and for put when S is greater than K, because payoff function for a put option is K minus ST. Okay, that is the strike price minus the underlying asset price. Then finally, we have the third category of moneyness, that is at the money options. And at the money options are those options which provide a zero payoff. That means if you exercise it today, no payoff will be received. You will receive 0 rupees in terms of payoff. And that is a scenario when strike price and asset price are equal. And it is true for both the options, be it call or put option. Okay. So for both call and put, if S is equal to K, we call the option at the money. Next, let's understand very quickly what are the payoffs of different types of option and the different types of positions also. So if it's a long call, that means you have bought a call option. So in that case, the payoff is given as max of S minus K or 0. Now, in the previous slide, I was mentioning that the payoff is S minus K. Okay, but here I'm saying S minus K or 0. And it is practical. You see, there we were doing it hypothetically. It was not in practice, because if the payoff is negative, then you will not exercise the option, and in that case your payoff will be 0 from the option. Okay, and this is the graph of payoff for a long call option. Okay, next we have the short call option, which is just the reverse of long call. And if you look at the short call payoff also, it's simply the negative or max of S minus K or 0. That means negative of long call payoff. Okay, and always remember, long call gets the right. Okay, that means it's up to the long call holder whether he will or she will exercise the option or not. But in the case of short call, that is short position, they are under the obligation. Okay, that means if long call position holder decides to exercise the option, then short call position holder will have to deliver the obligation. There is no way out for short position, be it call option or put option. And that's why here you see the maximum payoff for a short call is actually 0. The maximum payoff. Profit is a different thing. We'll come to that, okay, in the next upcoming slides. But the maximum payoff for short call is 0. But for the maximum payoff for long call is actually unlimited. Okay, because as hypothetically, if I say, it can go up to infinity. There is no upper bound to the stock price that it can reach. However, in a limited time frame, that's next to impossible, but its probability is practically not 0. Okay. Next, payoff of long put. Long put gives you the right to sell the underlying asset at a certain price. Okay. And in this case, it is the payoff is K minus S. And it is ideal if it is ideal to exercise the put option when the asset prices are less than the strike price. That would give you a benefit, because if let's say in the market the asset price is 40 and the strike price is 50. So if let's say you didn't had the put option with you, so in the market, you will be selling it at 40 rupees, correct? Because the asset price is 40. But if you have the put option with the strike price of 50, you will be able to sell it at a higher price. Not at 40, but using the option, you could sell it at 50 rupees, thereby giving you an extra benefit of 10 rupees. And that benefit is your payoff in the case of put option. Now, unlike call options, long calls, long puts do not provide unlimited payoff. You need to remember, because it may be a scenario, it may be the case that there is no upper limit to the stock price. Okay, it can go as high as possible, although the probability of that happening will be very close to 0. But there is a chance that it can happen. Okay, but in the case of put option, you see, it is beneficial when the stock price decreases. So there is a limit to which the stock prices can fall, and that limit is 0. Stock prices cannot go below 0. So the maximum payoff that you can have is actually the strike price. Okay, that is the value of K. So there is a limit to the maximum payoff in the case of long put, but there is no limit to the maximum payoff in the case of long call. Okay, similarly for short put, it's just the reverse of long put, and it is given as negative of the long put payoff, that is max of K minus S or 0. Okay. Next, let's understand the difference between payoff and premium. Now, you see in the previous slide, I was mentioning no matter what is the type of option, if it's a short position, that means you have sold the option, be it call or put, you are under the obligation. Now, since you're taking the obligation and the other party gets a preferential position, that is, he or she gets a preferred position. They get the right, but you are under the obligation. So for that, you receive a premium. Okay, that is in the form of call option or put option price. Okay, that's the premium. And payoff is different from the premium. Okay, payoff is upon exercise, what is the exact benefit that you get out of the exercise. Okay, and premium is the money that you pay to the opposite position holder, to the short position holder, to get that right. Okay, in order to get the right, to get the privileged position, you had to pay something, and that payment is called premium. And practically speaking, profit is given as payoff minus premium. So for a long call position, just think it logically that if you are a long call position holder, that means you are buying that privilege to exercise. It is up to you. If you want to exercise, you will. If you don't, you won't. Okay. So you paid a premium of, let's say, 2 rupees. Okay. And let's say the option matured, maturity came, and you exercised the option and the payoff was 10 rupees. So is it your exact profit? Practically speaking, no. In reality, it is not your exact profit, because when you acquired that option, you paid 2 rupees. So you will subtract that cost from the payoff to find out the exact profit that you have earned. So if your payoff is 10 rupees, you will subtract 2 rupees from it, and your payoff will be 8 in that case. And here the same thing has been explained. The red line that you see actually is the payoff line, and the green line is the profit line. And profit is slightly below. In fact, for some stock prices, it is less than 0. Okay, and it is less than 0 by the amount of premium that you have paid. Okay, so if your premium is 2 rupees, when the option is not exercised, your loss is 2 rupees. But when the option is exercised, your losses will first reduce, and then it will go up to positive. Okay, so that's the thing. Now let's understand one by one what is the profit from long call, short call, long put, short put. Okay, very quickly. So here we have a profit curve. If you look carefully, you see there is a very stark difference between profit and payoff lines. Okay, payoff line always start from the x-axis. Okay, but profit line usually start below the x-axis. That means from the negative y values, because initially if you're not exercising, you are losing the premium that you have paid. Okay, so that's your loss in that case, and that's why negative profits are shown here. If I see the option premium is actually 4 rupees. So for long call, it's a cost. That means it's a kind of loss. If the option is not exercised, I will lose 4 rupees. Okay, or $4, whatever it is. So $4 is your minimum maximum loss that can be incurred. Now here, in this case, profit is given as payoff minus the option premium, which is in this case $4. If let's say the strike price is 60, then it is simply given as S minus 60 or 0 minus 4. If S is greater than 60, that means if asset price at the time of maturity is greater than the strike price. Okay, let's say it is 61, 62, 63, 64, whatever, below, above 60. So in that case, the profit is given as, if you generalize it, S minus 64. Okay, now you see the difference. Actually, even if, although the strike price is 60, but even if the underlying asset price is increasing, for certain stock prices, you may not have a positive profit. You may have a positive payoff. There is no doubt. Okay, if the asset price is 61, then you have a payoff of 1 rupees, but your profit is actually negative, because in order to get that 1 rupee payoff, you had paid 4 rupees in the form of premium. So you will subtract that and you end up with a loss of 3 rupees in total. Okay, so in order to acquire profit, the stock price should go beyond 64 in this case. So always remember, for profit, if you want to find out the profit, or you can say the break-even asset price, where you have no profit, no loss scenario, or from the point onwards, you will start accumulating profit, you need to simply add the option premium in the strike price. So if a strike price is 50, option price is 3, the payoff will start from 50 minus 50 plus 3. That is $53. Okay, if the stock price goes beyond 53, you will have a positive profit. If it stays less than 53 but greater than 50, okay, it has to be greater than 50, then you will have some losses. Okay, although not exactly the option premium loss, but some losses. Okay, maybe 1 rupee to $1, $2, $3 at max. Okay, but it will be restricted to $3 only. If S is, so this line that you see here, actually starting from 60 rupees, this line is P equals to S minus 64. And then if S is less than 60, option is not exercised, there is 0 payoff, but you lose the option premium. So in this case, your profit is minus 4 rupees. And here, actually, this horizontal line below the x-axis represents the line P equals to minus 4. Okay, so that's the scenario for profit from long call positions. Now let's talk about short call, which is obviously the reverse. In the case of short call, they receive the premium. So initially they are in a profit scenario, which is $4. But if the option is exercised, gradually they will start incurring losses. However, their losses will be slightly less. By what amount the losses will be less? The losses will be less by the amount of the option premium, by the amount that is equal to the option premium. Okay. Now here, as I said, it is simply the negative of the long call profit. Long call profit was max of S minus K or 0 minus the call option price. You simply add a negative sign. That becomes it. Okay. Or in other words, C naught, or you can say option premium minus max of S minus K or 0. Okay. Next, talk about profit from long put. In the case of long put, this is the profit line that you will see in the case of long put position. Again, it goes below because for strike prices, for asset prices greater than 60, put option is never exercised. Put option is always exercised when the stock price is less than the strike price. So that's why you see below, for all the stock prices below 60, you will have an increasing order line. Okay, a line who is actually uh, going towards positive direction on the y-axis. Okay. However, there is always a limit to the maximum profit that can be earned. But you see, this does not represent the actual maximum profit, because here the stock prices only up to 40 have been shown. Okay, not up to 0. Okay. Now, here the profit, I say, that will be max of K minus S or 0 minus the option premium of the put option, which is represented as P naught. And next, for short put position, for short put, again, it's really simple. It's just the reverse of long put, and it is given as negative of the long put profit. In simple terms, you can write it as P naught minus max of K minus S or 0. Okay, so that's the profit from short put. Okay. Now, exchange traded options on stock. So always remember CBOE, Chicago Board of Option Exchange, is the largest option exchange in the world, and they trade billions of option contracts each year. Okay, option exchange. I'm not talking about the derivative exchange. Okay, for in the case of derivatives exchange, as of now, National Stock Exchange India (NSCI) is the largest derivative exchange in the world. But when we're talking about options only, okay, then it's the CBOE. Remember the difference. Okay, if it comes in the examination, you should be aware of these things. And on CBOE, most of the options that are traded are on the individual stocks. So maybe options on Amazon stocks, Tesla stocks, Netflix, Alphabet, Facebook, on these things. Okay, and these are American style options. Okay, and again, let me tell you very clearly that in US you have American style options traded on the exchanges, but in on the Indian exchange, NSE or BSE, if I talk about, these are European style options that are actually traded. Okay, and American style options, as I said, it can be exercised on maturity or any time before maturity. Okay, both are true. Next, usually what happens, when we talk in theory, we talk about one option, two option, things like that. But in practice, things are slightly different. So if you go to, let's say, actual option trading or something like that, so there you will find that there are option contracts, not option. Okay, now each option contract is for certain number of underlying asset. So for example, usually you will find that a standard option contract is for 100 shares. Now, one call option gives the right to buy or sell one share. So if you have one option contract on 100 shares, so that means you are buying a lot of 100 options, be it call or put. You are buying a lot of 100 options. Okay, so remember that on exchanges we have option contracts, not a single option. Okay. Next, let's talk about the maturities on which these things are traded. So you see, when you will open the exchange website, be it CBOE or NSE, whatever, okay, you will see that there are options. They will have their strike prices. It will show whether it is a call option or put option. Okay, if it's NSE, you will see numbers like codes like EC and EP. Okay, that is European call, European put. Okay, and then they also show the maturity month, that in which month these things are going to mature. Okay, so when it comes to CBOE, I'm not talking about NSE, okay, because this course is US based, so they are mostly teaching what happens in the US market. So if we talk about CBOE, there are stock options are actually issued in certain cycles. Okay, there are 3 cycles in a year. One is January cycle, which comprises of 4 months, January, April, July, and October. Then you have February cycle, which comprises of months February, May, August, and November. And then finally, you have March cycle, which comprises of March, June, September, and December. So there are 3 cycles. Okay. Now, in an option contract, they will declare that this option is in which cycle. which maturity cycle. They will show it to you that, okay, this option is in February maturity cycle. In simple terms, February cycle, January cycle, or March cycle. Okay, it is predefined. It is given there. Companies decide in which cycle they want to issue in which maturity cycle they want to issue the option. Okay. Now, if let's say you want to identify that on a given date, if a stock is in certain maturity cycle, okay, then what maturities of the options on that stock will be available on the exchange? Okay, what all maturities will be available on the exchange for that option, for that specific option? So let's say that there is an option which is in February cycle, which is already defined. It is usually defined by the companies itself, by the issuers themselves, that this option is in this cycle. Okay, options of this stock are in February cycle, January cycle, March cycle, whatever. So let's say they have defined it as in February cycle, and currently, let's say it's the month of September. Okay, so there are two things that you need to understand in order to identify what maturities of the option contracts will be trading. Okay, so you need to look at the month, and then you have to identify the third Friday where it is. Okay, always remember third Friday is the benchmark. Now, before third Friday, you will see that the options that are traded are of the current month, the next month, and the next 2 months of the cycle. After the third Friday, because usually settlement happen on the third Friday itself. Okay, so if on the third Friday, current month options have been settled, so naturally after third Friday, you will not see options expiring in current month, because they have all been settled on the third Friday itself. Okay, so after third Friday, you will see options that are traded in next month with maturities in next month, the month after that. Okay, that is if it is September, then and if it is, let's say, a date is there which is after the third Friday of September, okay, you will see options which have maturities in October, the month after that is November, and the next 2 months of the cycle in which the option is. So in this example that I have taken here, the option is in February cycle. Okay, so in the first scenario, that means before the third Friday, the options will be in September, that is the current month, October, that is the next month, and the next 2 months of the cycle, that is February cycle, and you will look for months after October, which comes in the February cycle. So here we have the February cycle, we have February, May, August. These 3 months come before October, so these 3 won't be considered. Next, we'll see November, and then it's a cycle, right? As I said, it's a cycle. So November and then February next year. So here you see November and then finally February. Okay. If it's after third Friday of the month, that is after third Friday of the September, so it will be next month, that is October, the month after that, that is November, and then you will see the next 2 months of the given cycle. So it's February cycle. Now I will look here again, February, May, August, November. November is already here. I have to take 2 months after this. That will be February and May again. So February and May. It's a cycle, right? So October and November are for this year, and February and May will be for the next year. Okay, that's how maturities are decided. Next, if we talk about types of options based on the maturities, there are some short-term options also offered by CBOE. Okay, short-term options which are termed as weeklies. They have weekly expiries. Every week, some of these options expire. So these options have a life of a week. Every Friday, on each of the weeks, every Friday, these options expire, except for the third Friday. Okay, on the third Friday, all other options will expire, not the weeklies. They will not find weeklies expiring on the third Friday of any given month. Then you have long-term options, which are known as LEAPs. This is the full form, long-term equity anticipation securities, but these are options actually. Okay, and these are long-term options. It can have maturities up to 1 year, 2 year, up to 3 years at max. Okay, and LEAPs actually expire on the third Friday of January each year. Okay, so if it's a 1 year LEAP that you have purchased, 1 year LEAPs that you have purchased, then this LEAP will actually expire on the third Friday of the next year, January. Okay. So here the details have been given, which I have already explained. So weeklies mature on Fridays other than the third Friday of the month, and that typically have offered on several such Fridays. LEAPs on individual stock mature on the third Friday of January and provide maturities up to 3 years. They can have maturity extending up to as long as 3 years for LEAPs. Okay. Next, let's talk about margin requirement, and that's really important to understand because uh, In the case of futures, we know that there will be margin for both long position and short position holders. Okay, why? Because both are under the obligation, so there is a credit risk on both the sides. Okay, but when it comes to options, things are a bit tricky because one has got the right and other is under the obligation. So the one under the obligation is actually giving rise to the credit risk. Okay, so if let's say I'll give you a scenario why margin requirements are important in options and only for one position holder, I'll tell you why. Because if let's say you bought an option, you have paid the price, okay, for the privilege that you have got. Now it's up to you whether you will exercise the option or not. Yeah, the other party is not worried. Okay, so if let's say you do not decide to exercise the option, it's your choice. Nothing is gone. The other party is satisfied. He or she has received the option premium, correct? But if let's say you wish to exercise the option, then naturally, if it's a bilateral arrangement, if I, for the time being, ignore the central counterparty there. Okay, if it's a bilateral arrangement, so you will go to find the person who has sold you the option. If let's say that person disagrees or dishonors the agreement, the option agreement, then you lose money. That's what we call credit risk, right? So in order to mitigate this credit risk, exchange require margin from the short position holders, not the long position holders. Okay. However, there are a few more things, extra peculiarity that we need to understand because in the previous chapters, I think in futures market, you might have studied one thing called other uses of margin requirements, where you might have studied buying on margin. Okay. So in the case of options, buying on margin is not possible if the option has a maturity less than 9 months. So if you are trading into 3-month option, 4-month option, 5-month option, be it call or put, you cannot buy on margin. You'll have to pay the full price upfront. Okay, so if you wish to buy 100 options, okay, or let's say one option contract in this scenario, okay, so you will, and one option is option on one share is worth let's say $2. So you will have to pay $200 in full upfront. Okay, then only you will receive these call options. Okay, otherwise you can't. But if you have options which have maturities greater than 9 months, let's say 1 year, for example, leaps. Okay, leaps can be bought on margin, but only 25% of the total purchase price can be borrowed. Okay, so let's understand it differently. Okay, so let's say you have 200 rupees. One option is for let's say 5 rupees. So naturally you will be able to buy how many shares? I think 20 shares. Okay, 20 options. Sorry, 20 options. Okay. Now, if you utilize buying on margin, then you will be actually able to buy 25% more shares, 25% more options. So that is 5 more options. So instead of, although you have a price to pay for 20 shares, you will be able to buy 25. Sorry, you have the price to pay for 20 options. You will be able to buy 25 options. Okay, that's what we call buying on margin, and 25% price of the purchase price can be borrowed. So here the total price was 250, 25% you were able to borrow. Okay. Sorry, 225. Okay. You paid 225 rupees, $25 was actually borrowed from the broker, through the broker. Okay. Now let's talk about the margin requirements. If let's say for the seller of the option, that is a short position, if you're taking a short position in the option. So as per CBOE, the margin requirement includes, for short call, it includes 100% of the sale proceeds, because you're selling the call option, so you're entitled to receive the option premium. Okay, so if you have received, let's say, 2 rupees premium per option, and let's say you have sold 100, so 200 rupees, that's 100% sales proceed. That will be kept in your margin account. That is something that you will have to maintain as your margin. You can't withdraw it. Okay, and then you add something more to it. There are two calculations usually that are done. First calculation is 20% of the current stock price. Okay, current underlying asset price. Okay, 20% of that. And then you subtract any amount by which the option is out of the money. Out of the money means, let's say, for the sake of, because it's a call option. So let's say it's a call option, and right now the strike price is 50 and the asset price is 48. Okay, so S minus K is negative. That means the option is out of the money. By how much amount? By 2 rupees. So you subtract this 2 rupees from 20% of share price. Okay, that's first calculation that you do. Then second calculation that you do is calculate the 10% of the share price, simply flat 10%. And then you compare these two. Whichever is greater will be considered. Okay, so 100% of the sales proceed plus the greater of these two will be added, and that will be your margin requirement. Okay, so in practice, if you see how much money you have to pay from your pocket in your margin account balance is actually either of these two, whichever is greater, the greater of these two. 100% of sale proceed is received from the call option buyer. right? You are not required to pay for that. That automatically comes into your margin account. But this is something that you will have to add into your margin account. Now, the catch here from the examination perspective is that they might ask in the exam that how much money the short position holder will have to add into the margin account. In that case, the answer will be the greater of these two. But if the question says how much money should be or you can say, what is the margin requirement for the short position holder? It says margin requirement, not the amount to be added in the margin account. Okay, so margin requirement will be the greater of these two plus the 100% of sales proceed. Always remember that. Okay, and I am telling you, trust my word, in the examination, if it says that either of the two questions that I have mentioned right now, whatever they are asking, they will give both the options. Okay, so if you do a calculation, you might end up doing it wrong. Okay, so be very careful, read the words very carefully, what they are asking exactly. Don't get overexcited. Similar is true for short put position. Same calculations are done, 100% of the sale proceeds and the maximum of these two, which is same for both call and put options. Okay, now let's see an example. So for example, let's say a call option is there, which has a price of $4 per unit of the underlying. So one call option is worth 4 rupees, $4. Asset price today is $40 and the strike price is 41. So clearly the option is out of the money. Okay, it's a call option. Moneyness is checked for call option. Moneyness is checked as S minus K. So 40 minus 41, it is -1. So negative means out of the money. And by how much amount the option is out of the money? By $1. Okay. Now I'll carry out the two calculations. First calculation, 20% of the asset price, that is 20% of 40 minus the amount by which the option is out of the money, that is 1. So 20% of 40 is 8 minus 1, that is $7. That's your first calculation. Second calculation is flat 10% of 40, that is $4. Okay. Now I'll consider the greater of these two, that is 7. And then my margin requirement here. Okay, you see what is written here. Margin requirement per option is the option price plus the extra calculation that I have done, which is $11 per option is the margin requirement. Okay. And if let's say you have one option contract, which is for 100 shares, then your net margin requirement will be 100 into 11, that is $1,100. Okay. Now there is a catch here. This whole calculations that we have done, that is 20% of asset price minus the amount by which the option is out of the money, or flat 10%. It is true for equity options where you have options on stocks. But if let's say you have an option on index, so for example, S&P 500 or Nifty 50, whatever. Okay. So I'll not say Nifty 50 because it's about only the CBOE, not the NSE or BSE. Okay. So if it is on index, let's say S&P 500 or something like that, then in that case, this 20% that we have here is replaced by 15%. So again, this is a catch that you should remember. So these are the few tips and tricks that you should always keep in mind. Usually people think that, okay, margin requirement, 20% of stock price minus the amount by which the option is out of the money. Okay. But let's say in the question, they have asked about index. So in that case, it's not 20%, it's 15%. Okay, so these are the things that you need to remember from the exam perspective. These are important pointers where they can trick you actually. Now, over the counter market. So in over-the-counter markets, also we have options that are traded. So with while options on individual stocks, if I talk about individual stocks which are listed on exchange, they are primarily traded on exchanges. But if you want to find options on foreign currencies, interest rates, or any other variable like options on delisted stocks, okay, or options on bonds, something like that, then you will have to look at other places, which is mostly the over-the-counter market. Okay, and these markets, over-the-counter markets, are beyond the reach of common people. Okay, these are available, over-the-counter market are available to access only for big financial institutions and I would say financial big companies. Okay, not for people like us. We can't enter there. The entry price, the volume, the value of trade that has to be there in order to be in the OTC market is very high. Okay, it's not for people like us. The main advantage of OTC market is that financial institutions can tailor the options as per their needs. Okay, so they can identify what the client requires and accordingly they can plan out an option contract which will benefit them. Okay, which will fulfill their requirements. Okay, size of these options are large. Okay, in the OTC market, the size of option contract is, you don't find there 100 options or something like that. There are options in millions of options are traded in one go. Okay. And also they have maturities longer than those which we see on the exchanges. They can have maturities lasting as high as 5 years, 10 years also. Okay. And OTC options can also be exotic in nature. So OTC options can have standard specifications like what we have studied so far. Okay. Like a fixed strike price, fixed maturity, um, underlying asset price is clearly defined, payoff calculation is simple. Okay. That's one way. Then it can be exotic also, which have non-standard structures. And of course, we'll study different type of exotic options in the upcoming hours. Okay. So you'll see the different types of exotics, and exotics are always traded on the OTC market. You will never find an exotic option in the exchange. On exchange, standardized option contracts are traded. Okay. So that's the end of this chapter. Just give me a minute. I'll just start the new share and then we'll start. I'll just share the new slide and then we'll start the next chapter, that is FMP 13, properties of options. Yes. So now we are going to cover the second chapter in options. Okay, that is related to options, which is properties of options. And in fact, let me tell you one thing. If you understand properties of options properly, okay, then understanding VRM 16, that is the Greeks, will also become easy. Okay, I'll tell you the link between these two chapters. In fact, in the start only you will understand the linkages. Okay, and this is very important that you are understanding these links, because sometimes maybe it's not at all necessary to answer a question based on the Greeks that you have studied. Rather, if you have the basic understanding of how the option prices vary based on the different factors, you could be able to answer that question. Okay, so let's start the chapter. And there are mostly two things that we'll understand here. First, what are the factors that affect the option price? And second, the upper and lower bounds along with the put call parity. Okay. Basically, from the examination perspective, if I say put call parity, the derivation of put call parity is not at all important. Okay. I'll show you the application of put call parity. I'll solve a question for you. And I'll just tell you that, okay, somewhat like this, you will be facing in the examination, where they will exploit the put call parity to find out certain variables which are missing. Some of them will be given, others you will have to find. Okay. First, let's understand the factors. So there are 6 factors basically that affect the price of an option, possibly stock option. In fact, it can be any option. Okay. But since we are taking it stock because it's easy to understand there. Okay. Now, the first and foremost important factor is the current stock price, that is S naught. What is the price today? It can have an impact on what the option price will be. Okay, and that's why you will see on the exchanges usually that option price do fluctuate daily, because the underlying asset price keeps on changing. However, there are other factors also that change. For one more thing is that the time to maturity is changing as the day passes. The time left to maturity decreases. That also has an effect on the option price. Then the volatility of the underlying asset changes over day to day on a day-to-day basis. Okay, so that also has an effect on the price of the option. So, but current stock price is the most important factor. Okay, it leads to the largest change in the option price that you will observe. Next is the strike price. Of course, the strike price can also have an effect. But when I say strike price, do not consider the strike price of the same option is changing. Okay, consider two different options. Let's say there is a call option 1, call option 2. Both have same maturities, let's say 3 months. Both are on the same underlying asset. So the volatility, the underlying asset volatility, the current stock price, everything is same for both. The only thing that is different in both of them is the strike price. One has a strike price of, let's say, 50, other one has a 55. Okay, so what will be the difference in the prices? Okay, so that is what we are saying when we say that how the option price is affected by changing strike prices. Okay. Next, we have the time to expiration. Again, that is pretty direct. Time to expiration will have an effect as the time to maturity nears. It will have certain effect on the option price, because we know that option price comprises of two things. First is the time value of money. Second is the intrinsic value. Okay, so there is time value and intrinsic value. So as the time decreases, you are acquiring that time value, and time value will decrease with time. But intrinsic value is something that depends on factors like underlying asset price and all. Okay. However, from the practical perspective and from the examination scenario, if you'll ask me, okay, the important things are how stock price affects. Okay, time to expiration is something that in practice traders do not monitor. Okay, let me tell you very clearly. In practice, traders do not monitor how time to expiration will affect the option price, because the reason is very simple. There is no uncertainty about the passage of time. There is uncertainty about the strike price. There can be uncertainties about the asset strike price sometimes, and asset price all the time. Okay, there can be uncertainties about the volatility again all the time. but there is no uncertainty about the passage of time. So if today the time left to maturity is 3 months, that is, let's say in the terms of days, it's 90 days, then tomorrow for sure, the time left to maturity will be 89 days. There is no doubt about it. So if there is no uncertainty, the risk is the risk arising because of that is something which we should not be worried about. Okay. Then we have the volatility of stock price, which affects the option price also. Of stock price means the underlying asset price, volatility of underlying asset. That has a significant impact that is measured. Then you have the risk-free rate. This also affects the option price, but again, its effect is minimal. Okay. In the VRM 16 chapter, I'll show you a risk measure which actually assesses the change, the risk in the option due to the changing interest rate. Okay, due to the changing risk-free rate. Okay, and you will see that the fluctuations are very small. Again, that becomes another prominent reason that why in practice trader also not monitor the changes happening in the option price because of the risk-free rate. Okay, so risk-free rate and time to expiration are the least concern for an option trader. Okay, but stock price, volatility, strike price, and then finally dividends that are expected to be paid. These are something that traders actively manage, actively look for that. Okay, what is the paid dividend that has been announced? Okay, however, in case of dividends also, dividends have to be significantly large, usually more than 10% of the underlying asset price. Then only traders are actually more keen towards understanding that how it will affect the option price. But and also dividends are not paid continuously, they're paid intermittently, not frequently. And also if the dividends was paid last year, there is no guarantee that the dividend will be paid this year. Okay, although for some companies it's a norm that they usually pay the dividends, maybe very small amount, but they pay. However, it's not mandatory that you will receive dividends. Okay, there is no guarantee for that. Now, before we proceed, let's understand one by one how these things affect. So if the stock price changes, how the call option price is affected, how the put option price is affected. And for that, I have a very beautiful Excel file to share. So I'll just start sharing. Can you please confirm in the chat if you are able to see the Excel file? Just yes or no. Is the Excel file visible? Okay. So now you see here, yeah, got it. So now here what we have is actually an Excel, and since you are in the revision, okay, it's a crash course, so you guys will be better able to understand that what I have done here. I have calculated the put price, what is D1 and D1, then N of minus D1 and put price. Okay, so these are the formula, BSM formula that I have applied, and I have basically done all the calculations. I have actually built all the graphs for European style options, be it call or put. These are all European style options, and these are equally true for American style options also. Now, why haven't done American call option? It's difficult, of course. If I'm doing it on Excel, it's really difficult to build a binomial tree. Okay, it's a recursive function. Backward induction is there, so it's not as simple as it seems to do on Excel. And that's why, to keep things simple, I have used European style options. Now, there are certain specifications here on the top. You can see strike price is there, 50, volatility is there, risk-free rate is defined, and time to maturity 0.25 years, that's 3 months. Okay. Now, this graph on the right-hand side that you see on the top is the plot of change in the option price with changing underlying asset price. So here you see there are different stock prices on the x-axis, and on the y-axis you have the call option prices. Okay, so as the stock price is increasing, what is happening to the call price? Call price is also increasing, and we see a curve which is increasing line, which is increasing in nature, an increasing curve. Okay, but for put option, it's a decreasing curve, and it's reasonable to understand again why for call options. I can say clearly that if the strike price is larger and larger and larger, okay, the payoff will be, I would say, sorry, if the asset price increases to a large extent, sorry, then the payoff will be large, because let's say there's, for example, here in this case, the strike price is 50. Okay, so when it is 42, the chance that option will be exercised is next to zero. It's out of the money, and precisely deep out of the money, because it's too far away from the strike price. So you can see the option price is close to zero. Okay, but when it goes as high as 58, it's certain, when the price is 58, it is certain that it will be exercised. Okay, and that's why the option price, the value of the option actually increases. Okay, and it goes as high as I think roughly 8.5 or 9 rupees or something like that. Okay, $9 roughly. But for put option, increasing stock price is a bad news. So if the stock price increases for put option, the value of put option falls. So there is a reverse relationship between call and put with respect to stock price. If a stock price increases, call value increases, but put value decreases. So call price is directly proportional to stock price and put price is inversely proportional to stock price. Okay. Now there are two risk measures that I'll teach. And in fact, if you guys are already aware, two risk measures associated with call price with the underlying asset price. Okay, and these risk measures are called delta and gamma. Okay, now why only delta? Why delta and gamma? Why not only delta? Again, there is a reason for that. I'll give you an analogy also, just to keep things simple. Okay, next, the impact of changing strike prices. It's just the opposite. If the strike price increases, so the stock price will have to go more and more higher in order to be exercised. Okay, so if let's say an option has a currently the option underlying asset price is 50, and there are two options with same specifications on the same asset. Only thing is that their strike prices are different. One has a strike price of 50, that's it's at the money, and another one has a strike price of 60. So, and currently the stock price is 50. So clearly the option with a strike price of 50 is more likely to be exercised compared to the option with the strike price of 60. It is even possible that over the period of time, the stock price never reaches 60. Okay, and that option will never be expired, will never be exercised. So the larger the strike price, the lower the value of the call price. But the opposite is true for put option, because the larger the strike price, the more easily there will be more chances that the option will be exercised. Okay, because in order to put option to expire, the stock price has to go beyond the strike price, and the far away the strike price is, that there are less chances that that stock price will be breached by the underlying asset price. Thereby, there will be more certainty about the exercise of the option. So for strike prices relationship with call and put, I can tell you very simply that if let's say uh, I have a call option, then call option price is inversely proportional to the strike price, but directly proportional to the put price. Okay, so strike price is directly proportional to put price. So if a strike price increases, put price will increase. If a strike price increases, call price will decrease. Okay, next, what is the effect of maturity? Although I have said that maturity may not be as relevant as stock prices and volatility. Okay, but people do need to understand that how they will affect. So for both put and call, maturity, changing maturity, increasing maturity will actually lead to increase in the price of both the options, because the longer you wait, the more the chances are that a certain price will be reached. Okay, and that's why maturity are considered seriously. Okay, next, changing volatility. If you change the volatility, again, it has positive effect on both the sides. Okay, for both the options. Okay, so be it call or put options, if the volatility increases, the value of both call and put options will increase. Okay, finally, next we have the risk-free rate. So for risk-free rate, in the case of call, there is a direct relationship. If the risk-free rate increases, the value of call option will increase, but the value of put option will decrease. There is an inverse relationship. So risk-free, so put option price is inversely proportional to the risk-free rate, and call option price is directly proportional to the risk-free rate. This is the takeaway from here. Now, I said that when I show you the graph, I want to show you one thing, that why people usually do not consider risk-free rate. So you see, in this case, the risk-free rate has changed from 3.6% to 4.4%. That's approximately 80 basis point increase, and it's a huge increase if I'm talking about a very short time span of 0.25 years, that is 3 months. Okay, in 3 months, you will usually not see a 1% increase, 80 basis point increase in the risk-free rates. Okay, but just see the change that is happening in the option price. Okay, there are two reasons why people are less concerned about risk-free rates as a risk measure. First, they usually do not fluctuate severely. First, second, even if they fluctuate, the effect on the option price is negligible. So for example, when the interest rate was 3.6%, the option price was, here you can see, $2.41. Okay, but when it increases to 4.4%, it goes as high as $2.46 only. So there is only $0.05 increase, or change, I would say roughly $0.05 change in both the cases. Okay, here also it was initially at 1.96 and it fell to 1.91. Again, $0.05 decrease. Okay, so that's very small, negligible. There are other factors which are more of our concern and which also change quite frequently, and randomly. It's something which is very hard to predict that something like that will happen. So volatility and stock price becomes the foremost measure. Okay. Then finally, we have the changing dividends. Again, changing dividends have an impact, but the dividends have to be large. For example, here you see dividends initially were very small, which was $1. And if you compare it with the stock price, okay, if you compare it with the stock price, so $1 is how much? I think 1/50. It's very small. Uh, it's 2%. Okay, 2% dividend. So you can see that the price are for put option, it's comparatively low. For call option, it's again comparatively high. Okay, but as it goes as high as $5, the effect is quite significant. It goes, so put option price increases to as high as 5, and call option price decreases to as low as 0.5 from 2. Okay, so there is a non-linear relationship, although, but there is some kind of relationship which you can say that if dividends increase, the value of call option will fall, but the value of put option will increase. Okay, now let's get back to our slides and let's understand the other parts, that is the upper and lower bounds of the call and put option. Now here for your reference, I have just included everything in the table. So here we have the variable and what the effect they will have on European and American style options. So if it is current stock price, call option increases with increasing stock price. Okay, variable is increase. Everything is increasing in nature. Okay, so if current stock price increases, call price for both American and European style will increase, but put price will fall. Strike price increases, call option price will decrease for both European and American, put option price will increase. Time to expiration, American, both of them increase. For European, it is marked question mark. I'll tell you why. Okay, now in the slides, in the Excel file that I was using, I specifically said that I'm doing it on European style options. And there I showed that, okay, time to expiration has an effect. Okay, but in case of European style, it's irrelevant, I would say. Question mark simply means it's irrelevant because you are not going to, you cannot exercise the option early. Time to expiration makes sense when it can be exercised early. In American or style option, it has an effect. Okay, options can be exercised early. So time to expiration needs to be considered to an extent. But for European style options, cannot be exercised early. So it becomes totally irrelevant. Okay, and that's why question marks. Now for volatility, for both American and European style options, be it call put, if volatility increases, the value of option will increase, irrespective of its type. Risk-free rate, if the risk-free rate increases, the value of call options increase, but the value of put options fall. Then finally, we have the dividends. If dividend amount of future dividends increase, okay, if let's say the future dividends are higher, the higher the dividends are, the lower the call option value will be, and the higher the put option values will be. Okay, so that's the summary of this 6 variables and how they affect it. And let me tell you the risk measures that we are going to study. So related to stock price, we have 2 risk measures. One is delta, one is gamma. Both of them combinedly measure how the option price will change if the underlying asset price changes. Okay, then you have the time to expiration, related to which we have the theta, okay, which measures how the option price will change if time to expiration change. Then you have volatility, which is measured in terms of vega, okay, which tells us change in the value of the derivative with respect to changing volatility of the underlying asset. Then we have risk-free rate, related to which we have the Greek measure called rho. Okay, and as I said, since time to expiration and risk-free rates are less important for option traders, so theta and rho are less important risk measures also. Okay, predominantly in the real market, you will see investors or traders mostly monitoring delta, gamma, and vega. That's all. Okay, and time to expiration, that is theta and rho, they are looked upon at, but when it comes to managing the risk arising because of that, they are usually not managed. Mostly the risk arising because of the stock price, that is delta, gamma, and because of volatility, that is vega. These 3 things are managed. Okay, now let's see certain assumptions that we'll be using in the upcoming slides. So capital C and capital P is used for American style call and put options, and small c and small p is used for European style call and put options for the upcoming slides. So here we'll first understand what are the upper bounds for the option prices. So for call option, the upper bound is the asset price. Okay, and it is reasonable to say, in fact, for both American and European and American style options, it is reasonable to understand that you can't buy a privilege. You can't pay for a privilege which is you can't pay. Uh, how should I put it down? I am not getting the words exactly. You will not pay anything which is does not justify its value. Okay, so if let's say something you find that its value is at 50, you're not going to pay 60 rupees for that, right? So if let's say asset price is 60, so by any means it is not possible that the call option price can go beyond 60. No matter what happens, the call option price cannot go beyond 60. At max, it will be 60. That's the upper bound, the ceiling, you can say, beyond which the price can't go, be it American or European style options. Okay. Next, for put option, the upper bound is present value of K in the case of European style. And in the case of American style, it is simply K. Why K? In the case of American, because it can be exercised at any point of time. So the moment, so on any day it can be exercised. So on any day, K can be realized. So there is no meaning in finding out the present value of K. You can realize it on any day. But in case of European style options, you can realize K only at maturity, not before that. So if you are finding the upper bound of option price at any time before the maturity, you will use a hypothetical scenario where you will consider the present value of K only. Okay. Because K is something that can be realized at 2 months from now. So what is its worth today? Okay. What is its worth today? So today is present value of K. That's all. Okay. So that's why for the European style option, it's present value of K, and for American style options, it's simply K. Next, the lower bounds, the minimum price at which the options can be traded. So for European style option, it is S0 minus PV of K or 0, whatever is maximum. Okay. And for American style option, it is also the same, that is S0 minus PVK or 0. Okay. Next, for put option, it is max of PVK minus S0 or 0. And for American style put option, it is K minus S0 or 0. Okay, so that's the scenario here. And again, you might wonder that, okay, Shubham, you mentioned in the last slide that when we are talking about American style option, it can be exercised at any point of time. Okay, so we take into consideration K, and it rightly goes with the put option price. But why not with the call? Again, there is a logic, because call options, American style call options, are never optimal to exercise before maturity. Okay, it is always suboptimal, be it because of time value, intrinsic value, whatever you consider. Call options are always suboptimal to be exercised before maturity. So an ideal investor, and everything that we study is from the perspective of a reasonable investor, not an irrational investor. Irrational investor is none of our concern. So an ideal investor will never exercise a call option before maturity. So if something has to be valued today, and it has a value which will be received at a future time, then in order to find its value today, we'll have to consider its present value. Okay, not the future value. So K is the future value in the case of call option, American style call option, because it is suboptimal to exercise an American style call option. Yeah, call has right. Exactly. Call has right. And these are all for the long call positions, the upper and lower bounds, call prices. Okay. Now, let's move forward and let's see an example of lower bounds and upper bounds. So basic calculation has been shown, and question like these can be asked in the examination. Okay, so here what we have is a European style put option on a non-dividend paying stock to keep things simple. Stock price is 38, strike price is 40. Okay, time to maturity is 3 months, and the risk-free rate of interest is 10% per annum. Okay, now this 10% per annum is for options. We usually consider that the compounding frequency of interest rates is continuously compounded. Okay, because of the benefits we get out of continuous compounding in terms of option pricing and all, be it binomial model, be it uh, 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 BSA model, Black-Scholes-Merton option pricing model. All these things are based on the assumption that the rates are continuously compounded. And that's the reason most of the time we consider the rates being continuously compounded when we are considering options. So even if it is written risk-free rate is 10% per annum, in the examination also it is possible that you will find it is written that the risk-free rate is 4%. However, there is a 99.99% chance that they will specify the compounding frequency. But if let's say it's that worst 0.01% scenario where the compounding frequency is not specified. So if it's related to options, you can safely assume that it's continuously compounded. Okay. Now, here the specifications have been written down, and we are interested in finding out the lower bound for the option price. The lower bound. Upper bound is quite simple. It's S0. That is 38. There is no doubt about it. Okay. Upper bound is S0, 38. Okay. Sorry, it's put option. So PV of K, that is present value of 40. Lower bound, it has a formula European style put option, correct? So lower bound will be PV of K minus S naught, max or 0. Okay. So here max of PV of K minus S naught or 0. So calculations are done, and as you can see, the rates are taken to be continuously compounded. And here also it has been specified CC, that means continuously compounded. So 40 times e raised to the power of minus RT, which is the risk-free rate of return, and the time period, 3 months, is actually equal to 0.25 years. And always remember to keep the time period in years, okay, not in months. Always remember that. Minus the asset price today. So we get the lower price, lowest possible price is $1.01. So if I have the pre-specified strike price and asset price, then no matter what the volatility is, what the volatility is, okay, the lowest price at which the option can sell is actually 1.01. It cannot go below this. Okay, there is no chance. Now we have the put call parity. So for a non-dividend paying stock, put call parity is defined like this, which is C plus PVK equals to P plus S naught. And in fact, this is basically, you can say, the law of one price working here. Okay, I'll explain. So LHS and RHS can be considered two portfolios. LHS, you can say portfolio A, and RHS can be considered portfolio B. Portfolio A comprises of long position in call option plus an investment in the risk-free security, and the investment amount is how much? Investment amount is worth PV of K. Whatever is the PV of K, that much amount is invested in the risk-free security. Okay. Second portfolio comprises of a long position in put option and a long position in the underlying asset. Okay. Now, in the if in the literature, if you'll see, there is a proper proof given that these two portfolios will provide same payoff at maturity. So if they are providing same payoff at maturity, they should provide same payoff today also. Okay, that's the law of one price. Okay, so if two portfolios have same benefits, then they should sell for the same price, right? So that's why this equity comes here, put call parity we call it. And in the examination perspective, what type of question you will find? So you may find that put price is given, asset price is given, K is given, risk free rate. So basically the way is given where you can calculate PVK. They will ask you to find out the call price, or the other way around, they will ask you to find the put price, or maybe they will ask you to find the strike price, the risk-free rate, the time to maturity, whatever. It can be anything. Okay, the asset price, whatever. They can ask to find anything. Okay, one scenario I have considered here where I am asked, where the question is to identify the risk-free rate actually. Okay, because PV of K, it is K times e raised to the power of minus RT. Okay, so S is, that means as asset price is given as 35, call is 2, call price is $2, strike price is 36, put price is $2.5, and time to maturity is 1 year. Now we have to find R if it is continuously compounded. Of course, it is continuously compounded because that's how we use input call parity in the case of options in general. So I apply the formula and I have to solve for it. So here the solution has been given. I find the relationship for e raised to the power of minus R, and t is basically 1 year. So t vanishes. Okay, because any number multiplied by 1 is the number itself. So it's minus R. And you can then find R by taking log on both the sides. Okay, you take log on both the sides, you are able to find the value of R. And of course, you can use the calculator buttons to carry out these calculations. Okay, next, put call parity for American options. You see, American options, we don't have any exact put call parity. There is a variation of this put call parity where you can be sure that the difference between the call and put price, okay, will always have an upper and a lower bound. Okay, the difference between the call and put price on the same asset, okay, will always have an upper and a lower bound. Okay, so if you know the call price, in this case, how the questions can be asked, here I have an example also. So here the question that they can ask is that, let's say they have an American call option on a non-dividend paying stock and it has a strike price of $20. Okay, so K is given to us and maturity in 5 months. And the price is given as $1.5. So put call option price is 1.5. Current stock price is 19 and the risk-free rate is $10. Now I want to find out the price range for put option. You see, when we will discuss binomial tree model, I'll tell you few extra things about, BSM model, I'll tell you few extra things about American style options. Okay, so what you can be sure from here is that you can always find the price range. If the call option price is this much, what will be the price range of put option? That's the most reasonable use of this thing. Okay, another use can be if the put option value is this much, what will be the call price range? Okay, but that is something which is not used in practice. Remind me, I'll explain it when I discuss VRM 15, that is BSM model. Okay, I'll explain again. I'll get back to this point and I'll tell you why in the exam you will most of the time expect that they will ask you to find the price range for put option and not call option. Okay, there is a reason. There is a practical reason for that, because in practice this makes more sense. Okay, I'll tell you why. But first, let's understand. So here I have to find the price range for put price. That what will be the price range for put option. Okay. So the calculations have been done. Since it is an inequality, you have to be very, very careful. You see, because in the second step, I am getting a negative sign. Okay. So if I flip the negative sign, the inequalities also change. Okay. So when I multiply this whole inequality with -1, so my inequality changes. It becomes 1 is greater than equal to P minus C is greater than equal to 0.183. Okay. So always remember when such questions are asked in the examination, if you are doing a negative multiplication or a negative division, the signs have to be flipped. Okay. Signs have to be flipped. Addition, subtraction, no issue. But multiplying with opposite sign, multiplication with same sign, again, no problem. Okay. Sign will remain the same. But multiplying the opposite sign, the inequalities have to be flipped. Okay. Now I then subtract again. You see, when I added C, no change in the inequality. C is added on both the sides, on all the three places, on the LHS, on the middle term, and on the RHS. I have subtracted. We have subtracted C on added C on all the three places. Okay. In the middle, it simply vanishes because here we have already minus C. So minus C plus C vanishes, and we are left with P. So 1 plus C is greater than equal to P is less than equal to 0.183 plus C. Now C is known to us, it is $1.5. So we simply add it, we get the range. Now we make it more readable. So we just flip it. So we find that the put option value will lie between 1.6838 and 2.5. Okay, these are the two ranges within which the put option prices can lie, both inclusive, because here it is less than equal to, both are inclusive. Now, in the exam also, questions like these can be asked, that what will be the price range within which the put option price will lie. Okay, if these are the conditions and it's an American style option. Okay, now American calls on non-dividend paying stock. Here, as I can say, as I mentioned earlier also, while explaining the upper bound and lower bounds of the American and European call options, it can be shown actually that there is a valid proof, valid explanation. You guys might have studied it, and I'll not go into that because that's not as important from the examination perspective. But the takeaway is that it is never optimal to exercise an American style call option on a non-dividend paying stock before the expiration date. For put option, there can be scenarios where American style option can be exercised. Okay. But it is never optimal to exercise a call option. Okay, never. Now, what is the effect of dividends? So first we'll see the effect on lower and upper bounds. So if dividends are announced, this is how the new expression will look like. It is S0 minus PVK minus PVD or 0 for European style call. For European style put, it is max of PVD plus PVK minus S0 or 0. Okay. Then put call parity is also affected. If we have put call parity on dividend paying stock and the options are European style options. Okay. So in that case, on the LHS, that is portfolio A, actually includes one extra investment. Okay. So in the previous case, when I was explaining the put call parity, there were two things, C and PVK. So I shared that long call plus an investment in risk-free security worth PVK. Here you have three investments, a long call, an investment in risk-free security worth PVK, another investment in risk-free security worth PVD. Okay, why I'm not taking them jointly? Because it is possible that dividend is paid way before the maturity. So let's say maturity is in 3 months, dividend is paid at second month from now. So you can't consider only two investment. You'll have to have three different investment, because the investment worth PVD has to be withdrawn at 2 months from now, not 3. Okay, so that's why 3 investments. And then on the RHS, it's pretty simple. It's P plus S naught, that is long put plus long asset. Okay. So here another variation of this put call parity has been shown, where it is C plus PVK is equal to P plus S naught minus PVD. Okay. So S naught is long position in PVD and minus S naught is the long position in asset, and minus PVD signifies borrowing amount worth PVD today at the rate of risk-free rate, prevalent risk-free rate for the given period. Okay, so that's borrowing. That's another variation. Okay. Now for American call option, if you have the dividends, then inequality changes slightly, and only on the left hand side you will see it becomes S. Previously it was S naught minus K. Now it's S naught minus PVD minus K. Okay, so that's the only difference. Okay, so that's the end of this lecture. Now I'll start with the next chapter, that is FMP 14, which is trading strategies. So just give me a minute, I'll share the screen. So let's start our third chapter of our discussion, that is trading strategies. And in this chapter, we will actually see the different types of trading strategies that we can formulate using options. Okay, only options, pure options. Okay. Now, these are mostly useful in the long term when you have a period extending of 3 months, 4 months, not very short periods of time. Like these are not like day trading things. Okay. So these are for extended periods where you will have payoffs. Okay. So let's see what are the all trading strategies that are important for us. Now, first is covered call. So covered call, as the name suggests, it is covering a call position. So let's say you have a call option. So what is your risk here? It is obvious. You can say that the risk is the risk is that the call is let's say call option. That means you have a short position call. You have sold a call option, for example. Okay, so you have sold a call option. So what is the risk for you? Risk for you is that buyer of call option will come and I'll have to sell the underlying asset. You're a short call position. You are under obligation to sell. Buyer has the right to buy. Okay, but for short call, obligation to sell. So you'll have to sell the underlying asset. Now, if you don't have the underlying asset, how will you manage this trade? Okay, so in that case, you will have to buy the asset at the then prevalent price, which will be higher than the strike price. Then you will sell it at a lower price. So covered call actually means that if you have an existing short position in call option, you cover it with a long position in stock. Okay, so if the option is exercised, you will have a benefit out of it. Okay, so here's the diagram of payoff. So if the option is exercised, you will be able to limit your losses because you bought it at a lower price earlier. Okay, so let's say you bought it at 40. Now today the strike price was 50. Okay, and today the stock price is 60 and option is exercised. So the price that you paid for the stock is not 60, right? You paid it at 40. So you're somewhat managing your losses. So that's what we call covered call. You're covering your short call position, and since the name, and hence the name covered call. Okay. Now, covered call is beneficial if you look at from one side, one view, where the option will be exercised. But if the option is not exercised, that means the price has fallen. Okay, then only the option is not being exercised. So in that case, the position actually becomes worse. Okay, covered call becomes worse. But sometimes people do these things. They cover their call position. If it is certain that the option will be exercised, if they feel like that, they cover the call for some time. Then they keep the position naked for other time. Okay, these are the things that they keep on doing continuously, which is actually a part of Greeks only, risk measure. How do we manage the risk arising because of option trading? And especially if you are taking a short position. For long position, it's a little less concern, but for short position, it's a very huge concern. And as risk managers, you'll be working for big financial institutions who are market maker for these options. Okay, so they're sellers. So they need to assess their portfolio very actively. Now, protective put means, let's say you have existing stock position. So you want to protect your position from falling prices. So what you will do, you will buy a put option. That's why protective put it is called. Okay, protective put means you have bought a put option to protect your existing stock position. Okay, and again, this is beneficial when stock prices are falling. When you're certain that the stock price will fall, then protective put is a beneficial strategy. But if, let's say, instead of falling, the stock price actually increases, so protective put is often no use. You will let the put option expire. Okay, you will lose the option premium. Now, next we'll talk about, so these were the strategies that are actually built upon the put call parity. Let me tell you very clearly. So it was C plus PVK equals to P plus S naught, right? So if you look at protective put, it is European put option on a stock plus the stock itself. So it is long put plus long stock. Okay, so C plus PVK plus P plus equal to P plus S naught. P plus S naught was the portfolio B. So protective put is nothing but a portfolio B. Okay, now another variation of put call parity gives you the covered call actually. Okay, so covered call was short call plus long stock. Okay, so just do one thing, just flip the put call parity. Okay, take the call option on the RHS and put option on the LHS. So your equation will become PVK minus P. Okay, PVK minus P equals to S naught minus C. So this S naught minus C is nothing but your covered call. S naught long stock minus C short call. Okay, covered call was that only. So these strategies are actually protective put, covered call. These are built by manipulating the put call parity. And that's why when I was explaining the put call parity, I mentioned that put call parity is nothing but equality of two portfolios, portfolio A and portfolio B. Okay. No, it's at protective put only. Are you able to see the protective put? Can you guys confirm if you're able to see protective put? Okay.
Yes, we can. Yeah, now I'm spread. Yeah, back to protested.
Now let's
Good.
talk about spread strategies. Okay, so you see, when we talk about trading strategies, there are two types of strategies that are actively used. One is a spread trading strategy, another one is combination trading strategy. So from the examination perspective, one very important thing here is to understand the difference between spread and combination. So spread is a trading strategy which involves taking position in two or more options, uh, two or more options of the same type. That means uh, you are taking positions in 2 3 options. Okay, and all these options are either call or put. They are not combination. They are not a combination of call and put. Okay, it's only call or only put. Okay, if you're only using these things, we call such strategies spread strategy. Okay, on the other hand, if let's say you are creating a strategy where you are using some call options, along with it you are also using some put options, so you are combining two different types of options. These type of strategies are called combination strategies. So that's the most basic difference which can be exploited from the exam perspective. Next, if we talk about spreads also, spreads can further be classified into three different types. Okay, first is horizontal spread. Horizontal spread means same strike price but different time to maturities. Okay, on the same asset, of course. So if let's say you have option A, option B, call option A, call option B. Okay, both are on the same asset price, both have the same strike price of 50. Okay, but option A is expiring in 2 months and option B is expiring in 3 months. So it's a horizontal spread that we're talking here. Okay, next what we have, same K, different T, as I mentioned. Next we have the vertical spread, where the time to maturity is same for all the stock, for all the options, but the strike prices are different. Okay, so for example, if let's say you have three options under consideration, call option A, B, and C, all are calls. Okay, or let's take put options. Put options A, B, and C. They are all maturing in 3 months, but they have different strike prices. Let's say 35, 40, and 45. Okay, so it's a vertical spread that you have created. Okay, and we'll see in the upcoming slides. There will be some spreads which are horizontal, some which are vertical, some which are diagonal also. Okay, then finally we have diagonal. Diagonal means different strike prices as well as different maturities. So let's say you have two call options, call A, call B. One has a time to maturity of 2 months and a strike price of 50. Another has a time to maturity of 3 months and a strike price of 55. It's a diagonal spread. Okay, so here you have created a diagonal spread because for both the options, both strike prices and time to maturity are different. Okay, so different P, different K. Now let's understand certain spread trading strategies which are important from the examination perspective. So most common one is bull call spreads. Okay, so bull call spread is, as the name suggests, this is a spread strategy which you will implement when you are bullish about the market, when you have a bullish feeling about the market. And call means this spread is actually created using only call options. Okay, so bull call spread actually means that I would say, just a minute. Okay, yeah. So bull call spread actually means that you are expecting an increase in the price. Okay, what the idea is, I'll explain that. So you are expecting an increase in the price, so you bought a call option. Okay, but you want to limit your losses in the case of decline. Okay, limit your losses in the case of decline. So let's say you bought a call option which is priced at $5. Okay, why you bought a call option? Because you are bullish about the market, the price will go up, I'll benefit from. But $5 is a huge cost for you, let's say. So you would want to limit this loss. You would want to reduce this loss even further. Now again, limiting loss comes at a cost. You will have to limit your profits also. So what you do, you sell a call option at a significantly higher strike price. So if the strike price is higher, we have studied in properties of options, strike price is high, call price will be low. Correct? You you sell a call option with a significantly high strike price. So you feel like, okay, the price will increase. Maybe let's say you bought a call option at price 50. Okay, so you feel like the price will increase from 50, it will go beyond it. But let's say you are expecting it will not go beyond 60. Okay. Or if let's say it goes beyond 60, then you're okay with limiting your profits, because after 60, the profit will be blocked. Okay. You can't have increasing profits after 60. After 60, the profits will be fixed. Okay. It will not change. So you're okay with that. So in this case, but you want to limit the losses. That is for sure. You want to limit the cost. So what you do, you sold another call option at a strike price 60. Okay. And that leads to a scenario where you sold the call option, you received a premium, let's say 2 rupees. Now your cost is limited, 3 rupees only. You paid 5, you get back 2. Cost is 3 rupees only. But the but risk is reduced to 3 rupees. But the profits are also limited now. The maximum profit in this case that you can earn is actually $10. Okay, because beyond 60, the second call option will also be exercised, and any excess profit that you earn will go to the option buyer that you had sold initially. Okay, so that's how bull call spread works. They are a way to limit uh, limit the cost and limit the losses at the cost of profits. Okay, if you're limiting losses, your profits will also be limited. Okay, so payoff is given something like this payoff scenario. So here, when what you do, you buy a call option with a smaller strike price and you sell a call option with a larger strike price. Okay, so K1 smaller strike price, K2 larger strike price. You sold it. When the asset price is less than both the strike prices, there is no payoff. You have zero. Your loss is also limited to $3 only. When it is between these two prices, K1 and K2, you will have a payoff which is equal to ST minus K. So if let's say strike price is 50, the asset price is 55 at maturity. Second option is never exercised because the exercise price is 60 for that. But your first option is exercised, which has $5 payoff. If ST is greater than the second strike price also, the larger one, then the maximum profit that you will have beyond this level is K2 minus K1. That is, in our example, 60 minus 50, that is $10. That's the maximum profit. Okay, that's the bull call spread. Next, we have bear put spread. Again, as the name suggests, if you are bearish about the market, then we put in place the bear put spreads using the put option. And in this case, you actually, as it is written here, you can say you buy a European put with one strike price and sell European put with another strike price. Okay, the option purchased is greater. So you buy the put option with the strike price K2 and sell the put option with the strike price K1. Again, in this case, if the asset price falls below K1, because it's a put option, you are bearish. So you're expecting a fall. If it falls below K1, the profits are limited to K2 minus K1. Okay. But if it goes above K2, then your losses are also restricted because you're buying a put option at a higher strike price. You pay a higher cost, of course, and you're selling also at a lower strike price. That means you're receiving some amount of money also. Okay. So there is cost reduction, but it comes at what? It comes at a cost of reducing profits also. Okay. There is loss reduction at the cost of profit. And here, the payoff structure is simple, very simple, just the reverse of what you had for bull call spreads. Okay. So when ST is less than both the strike prices, payoff is K2 minus K1. When SD is between these two, payoff is K2 minus ST. This is the only difference. In the previous case, it was ST minus K1. Here it is K2 minus ST. And if the asset price is greater than the larger of the strike prices, then the payoff is simply zero from this trading strategy. Okay. Next, we have the box spread. Box spread is basically combination of bull spread and bear spread. So bull call and bear call, you combine them, you get a box spread. Box, why? Because the payoff is a box. It looks like a box. No matter what the strike prices are, where the movement will be. Okay. Whatever happens, there will be some payoff. Okay, and it's a fixed payoff that will be equal to K2 minus K1. Okay, here you can see, and you can find the present value also, PV of K2 minus K1. So the payoff, no matter what happens to the stock prices, if you are able to establish a box spread, payoff is fixed, K2 minus K1. However, box spread are costly. So you need to ensure that if you are buying a box spread, then the price should be less than PV of K2 minus K1. If it is greater than that, then selling the box spread is more beneficial. Okay. However, if it is less, then buying the box spread is more beneficial. So you will have to carry out this calculation always. PV of K2 minus K1. Okay. Then compare it with the cost. If cost is greater, sell the box. If cost is less, buy the box. Okay. Next, we have butterfly spreads. Butterfly spreads are beneficial when you're expecting some movement, not large, but some movement, but you are not able to decide in which direction the movement will be, whether it will be a positive movement or a negative movement. You know the upper and lower prices, that okay, the movement will be within these two prices only. Okay, but you're not sure in which direction. Okay, so what you do, you put in place the butterfly spread. It helps you to get small profits when the price fluctuate between the two given ranges. Okay, and here if you look at the graph, it is K1 and K3. Now the selection of options is very carefully done. Okay, the strike prices. So here I have the butterfly spread created from call options, and three strike prices are selected. K1 and K3 strike prices are bought. So let's say K1 is 30. Okay, so you bought a call option with the strike price 30. Let's say K2 is 40. You bought a call option with strike price 40. Okay. Then K2. Okay. K3 was 40. Then you have to do something about K2. So you have to sell two call options with strike price K2. But there is a condition that has to be fulfilled. K2 has to be the average price of K1 and K3. So in this case, K1 was 30, K3 was 40. So average price of 30 and 40, it will be 35. So I will sell two call options with strike price 35. Okay. And that's how I create a butterfly spread. And here my profits are pretty simple. Okay. My profits will look like this. When ST is less than K1, payoff 0. When ST is greater than K3, again payoff 0 on both the sides. So that's why I said, if you're expecting that within the two price range, the value will fluctuate. Okay. Within the two prices, the underlying asset price will fluctuate. That is K1 and K3 are the two upper and lower bounds. Okay. These are the browns. So your expectation was that the fluctuation will be within K1 and K3, not beyond that. So if it goes beyond that, payoff is naturally 0 on both the sides. But if it stays between these two, then there is some positive payoff. Okay. If the strike price is between K1 and K2, the payoff is ST minus K1. And if the strike price, if the asset price is between K2 and K3, the payoff is K3 minus ST. Okay. So that's how these things work actually.
Is that how that should be?
Now, butterfly spreads can also be created using put options. Again, same strategy. Buy put option with strike price K1, put option with the strike price K3. These things are bought, and two put options with strike price K2 are sold. Okay, profits and everything will stay the same. Okay, payoffs will also stay the same. Okay, now calendar spreads. Calendar spreads. So till now, what we discussed here were all vertical spreads. Okay, they were all maturing at same point of time. Time to maturity was same. For example, 3 months, 4 months, 5 months, whatever. Okay, but strike prices were different. So these were our vertical spreads. Calendar spread are actually you can say either horizontal or diagonal. Okay, calendar can be both horizontal or diagonal. Okay, so if it is considered horizontal if the time to maturities are different, but the strike prices are same. So it will be considered horizontal. But if both the things are different, then it will be considered diagonal. Okay. Now calendar spread here, it has been shown. If we talk about the payoff line, see this black long line, the dashed line that you are seeing is actually the payoff line. Okay. And why it is a non-linear curve and why we can't have a specific payoff at discrete prices. The reason is very simple. And here also, if you look at the portfolio, okay, portfolio profit, a very small profit happens for over a very short price interval. Okay, a very small profit happens. Okay, and that too, the lines are not linear; they are non-linear. Okay, in the previous slides, if you look at here, for example, we had clear clear points everywhere. Okay, there were clear direction change. But in case of calendar, I thought that we are using butterfly spread when we are almost sure that price will be in the end as we expect, but we are using it when we don't know what will be the movement. Yes, you see, that's also an objective. There can be multiple scenarios when you can apply a trading strategy. Okay, in fact, the scenario that I mentioned, that I am sure that the movement will be within these two prices only, but I'm not sure what the price will be exactly. That's what I'm saying. Okay, so I'm not sure that whether it will be exactly 35 or 36 or something like that. So in that case, we do it. Okay. Now, here, these are not sharp edges that you see here. The reason is simple, because here we are using two options. Let's say one option is maturing in 3 months, another in 5 months. Okay. So the position is closed at 3 months from now. And these are European options. So the option maturing at 5 months is not exercised. Okay. So you were long in that option. You're just closing out. And what you end up with is the differential option money. Okay. Option premium. You close out the position, you end up with a differential option premium. That's your benefit. Okay. And we know that option price has a non-linear relationship with the underlying asset price. And that's why the reason we have this non-linear curve for the profit. Again, here also a small profit is observed. Okay. Next, calendar spread can be created using put options also. And the graph is quite the same for put options as well. Okay. Now, let's talk about combinations. So from the examination perspective, there are two combinations which are important. One is straddle and another one is strangle. Okay, and we'll see both of them. Now, in the case of when straddle and strangle will be beneficial, let me tell you a scenario. So let's say, and these work, straddle and strangle work very well in highly volatile markets. Okay, highly volatile, because there is uncertainty. For example, let's consider a company which is into a legal dispute. Okay, some kind of legal dispute. Now we know that if the company is charged, if let the company is found guilty, then it will affect its reputation. Okay, and definitely the stock price will fall. Okay. On the other hand, if the company is found not guilty, then its reputation is strengthened and the stock price will go up. Okay. So here, let's say there is a dispute, legal dispute going on. The case is running in the court, and today we have some kind of hearing or something like that. So that's a very special day. Why? I'll tell you. Because on that day, anything can happen. Maybe there will be something happening in the favor of the company, which will lead to the stock prices going up. Maybe the court will say something which is not in favor of the company, leading to the stock prices going down. Now you want to benefit from this scenario. So how you're going to benefit? Their straddle and strangle helps to your rescue. Okay. What they do is that what you do here is that you buy a call option and a put option. Okay. In case of straddle, you do it at the same asset price, same strike price. Okay. Same strike price. Let's say 50. Today the stock price is 50. You bought an at the money call option and at the money put option also. Okay. But the problem with straddle is that it has a very high cost. That's the only problem. Very high cost. So uh, a modification of straddle is strangle, where you reduce the cost by keeping the strike prices apart, a little bit apart. Okay. So you make both the options out of the money. You buy a put option with a higher strike price, thereby reducing its price, and you buy a call option with a lower strike price, thereby reducing its price. Okay. So that's how you buy you put the strangle. So if you understand the idea of straddle, you will understand strangle also. Okay. The only difference is in the different strike prices. So what you do here is you buy this thing. Okay. So you are now waiting. Court happens. Okay. Hearing happens. If let's say in the hearing something happens in favor of the company, stock price will go abruptly high. Okay. Stock price will skyrocket. You will let the put option expire and exercise the call option. You get the benefit. Okay. If let's say there is something happens in the court which is not in the favor of the company, the stock price will plummet. Okay. It will go to the ground. So you will let the call option expire and exercise the put option, thereby making profits on either side movement. Okay. When the movement is on the either side of the stock. Okay. Of the stock price. But the problem here in case of straddle is that the cost is very high. So in order to have payoff, it is possible that you can have a payoff. But in order to have a profit, a straddle to work, you will have to have a very huge jump or very huge decline in the price of the asset. Okay. Now, this drawback is covered from strangles, where call option is bought at a strike price K2 and put option is bought at a strike price K1. Okay. So thereby reducing the cost, and of course, for some period, since the cost is reduced, for some stock prices, you won't have a payoff, but at least the cost is reduced. Now, if it goes beyond this, you will have positive profits. Okay, so that's how these things work. Okay, straddle and strangle. There are two more, strips and straps, which are just the variation of, I would say, straddle only. Okay, or strangle, you can say, strip and strap. Which just shows your inclination. So if let's say you're more inclined towards the fall rather than increase, so you buy more put rather than calls. Okay, so that's the strip. If you are more inclined towards the increase in the stock price, so you buy more calls but less puts. That's called a strap. Okay, that's how strip and strap are. Okay, it's just a variation of straddle only. So straddle is the basic. Strangle, strip, strap are all the variations. Okay. So with this, we have completed this chapter. Now, let's have a very short break of 15 minutes. Don't leave the meeting. Just keep yourself muted because we have been sitting for like almost 1.5 hours. It's 1 hour 40 minutes. So let's have a 15 minutes break and then we'll resume the session. Okay. Yes. Hi guys. Can you please confirm if the screen is visible and my voice is audible? Please confirm in the chat. Please keep your webcam off. It's not at all necessary. Yeah. Okay. So let's start the fourth chapter of today's discussion, that is FMP 15 exotic options. Okay. Now in this chapter, we are going to cover, as I mentioned in options market chapter, that is FMP 12, that in OTC markets, a lot of options that are actually traded are exotic in nature. And when I say exotic, it means that they have non-standard contract specifications. It can be of any type. It like, for example, if I talk about a standard option specification, it's fixed strike price, fixed asset price. Okay, you have the nature of the underlying, which is fixed. You have time to maturity, which is fixed. And if we tweak with any of these variables, we are actually converting that option into an exotic option. Okay, so now we are going to start with exotic options. So let's see what these exotic options are. First, non-standard American option. You see, exchange traded American options, especially since we are talking from the perspective of American markets, and we know that in American exchanges, a lot of options that are traded, standard options that are traded on the exchange, are American style options. So on exchange traded, we have predetermined fixed strike prices, fixed maturities and all, everything. There can be variations to these standardization. And these variations are found in over-the-counter markets. One of the variation is Bermudan style options. Okay. So what is Bermudan style option? You see, if it is a standard American style option, it gives you the right to buy or sell the underlying at any point of time on or before the maturity. Okay. But in case of Bermudan style, the time at which it can be exercised before maturities are actually fixed. So for example, let's say it's a 4-month American style option. Okay. So they may specify that although it's an American style option, you can exercise it before maturity, no doubt, but you can exercise it either at 1 month from now, at 2 months from now, at 3 months from now, and then finally at maturity. So this kind of structure is called Bermudan style structure, where you can exercise it before maturity, but not at all times. Only at certain specified times you will be able to exercise. And that's why, for example, here, if let's say this is your time zero, this is your time to maturity, and there are 4 periods before maturity, 4 time stamps before maturity on which you can exercise the option. So if this is the criteria, this is the specification, it's a Bermudan style option. Then you can have options which can have lockout periods. Lockout periods means although it's a 4 style American style option, but for initial few days or few months, you won't be able to exercise it. So for example, let's say it's a 4-month option, but it has a lockout period of 1 month. So for the first 1 month, you cannot exercise the option irrespective of what happens in the market. Okay, so that can be another variation on the maturity. Third is you can have varying strike prices. Okay, that's also possible. And in fact, we will see varying strike prices, a lot of options with varying strike prices. which is you can have Asian options in an example of varying style options is Asian style options, where strike prices or asset prices are defined slightly differently. Okay, we'll see those things. So, and if we talk about the nature of the underlying, so we can have single underlying, you can have only option on a single stock or a single underlying variable, for example, a single currency, things like that. On the other hand, you can also have multiple underlying. A classic example is basket option, where you have an option to exchange certain number of transactions, to sell certain number of transactions. So let's say you will be receiving you are like, okay, there are future transactions that are yet to happen, currency transaction, let's say. Okay, let's say one is in USD, EUR USD, then second one is CAD USD. Okay, things like that. There are 3-4 transactions. Okay, then you have CHF USD. Okay, let's say 3 transactions are there. So if you are using standard options, you'll have to buy 3 different option contracts in order to hedge your position. But instead, if you buy a basket option where all the 3 transactions will be bundled together, a certain strike prices will be specified, and in bunch at a specific time, you could hedge the risk altogether. Okay, you could sell these transactions or buy these transactions at a future date using the option. So this is where you have multiple underlying. You don't have a single underlying, like you don't have only one currency pair, you have 2-3 different currency pairs. Okay, that's what we call multiple underlying. Or you can say you can have an option on a portfolio of stocks, not a single stock, but a portfolio. Let's say it contains 5, 6, 7 different types of stock, and you are just exchanging the portfolio, where portfolio return is specified, that okay, this is the return that is being promised. If anything is below that, you will get some payoff. If anything is above that, you'll end up paying something. Okay, so that kind of structure can be made. Now let's talk about some important exotic options, and first one of them is the gap option. And gap option is basically is a European style option. It can be call or put option, where you have 2 prices, okay, defined. One is the strike price, using which the payoff is calculated. Okay, another is the trigger price. Okay, so no matter what the strike price is, if the asset never reaches this trigger price, there will be no payoff. Okay, and the moment trigger price is crossed, you will have a payoff, and payoff will be calculated using the strike price only. Okay, so that's the benefit of gap option, and this trigger price can be way above or below the strike price. Okay, for example, if I talk about gap call options, so here we have 2 scenarios where trigger price are actually in first case higher and in second case lower. So there are 2 prices, right? K1 and K2. So K1 is the strike price, K2 is the trigger price. In the first case, you will have a payoff if and only if the asset price goes beyond K2. So let's take an example, very simple one. So let's say currently the stock price is 40. You have an option with a strike price 40, but the trigger price is 45. Okay, so in this case, at maturity, what will happen? There are 3 scenarios possible. First is asset prices below 40. Option is not exercised. Second is asset prices between 40 and 45. Again, the asset price option is not exercised. Why? Because it has not crossed the trigger price, that is 45. Okay, now the moment asset price goes beyond 45, let's say it becomes 46, 47, or let's keep it simple, let's make it 50. It becomes 50. Now you have a payoff. But the payoff is not calculated using trigger price. It's only calculated using the strike price. So here your payoff will be 50 minus 40, 10 rupees direct. Okay, so the thing is, the trigger price has to be breached, okay, in order to option to be exercised. In the second case that you're seeing here, the trigger price is below the strike price. Okay, strike price is K1, trigger price is K2, which is below the strike price. So in this case, again, 40 is the strike price. Let's say currently the stock price is 40 also, and the trigger price is let's say 37. So option will be exercised if and only if 37 is reached. Okay, at any point of time throughout the life. Okay, 30 is reached. If 30 is not reached, then option is not exercised. And the moment, let's say, let's say 35 is the trigger. So the moment 35 is reached, and then it starts to increase. Let's say it goes to 35, and now it ends at 39. So here you will have a payoff, and payoff will be 39 minus 40, that is minus 1. Here we have a negative payoff. So in case of gap options, negative payoffs are also possible. Okay, in case of gaps, can gap option be done on a call option which gives right and not an obligation? You get the right. Olayami, you get the right. Okay, but the thing is, since your trigger price is lower than the strike price, you may have a negative payoff. Here you are not under the obligation. It's just that specifications are more complex. You still have the right to exercise. Okay. Now, let's move forward. Let's see put options. In this case, here the trigger price is higher, the trigger price is lower. Okay, again, similar to it's just a flip of what we had for call options. Okay. Now, forward start option. So forward start option, as the name suggests, it will start at a forward time. Forward start. Not today, after some time. So if let's say you enter into an option contract where you're saying that, okay, I will buy a call option at this strike price, which will have a maturity of 2 years at 1 year from now. You're not buying it today. You are agreeing to buy it at a future date. Okay, that's what we call a forward start option. Usually, forward start options are not bought uniquely. That means a single forward start option is not bought. They are bought in bundles. Okay, so you will buy like, okay, I'll buy 4 forward start options. One will start at 1 year from now. Another will start at 2 years from now. Then 3 years from now. Then 4 years from now, and so on. And when you have such a structure, this structure is called a clicket. Okay, so if you have bought a bundle where you have 4 forward start options, which will be starting at, let's say, 1 year, 2 year, 3 year, 4 year. Hypothetically, it can be anything. Okay, from now. Okay, so it's a clicket that you have bought, or a ratchet. It has a two different names when you have a bundle. Next, compound. Compound is like buying an option on another option. Okay, so it's like you bought a call option today, for example. Okay, and this call option is not to buy the underlying asset, but to buy another call option with the specific specification in future. Okay, so there are 4 variations of compound options also, and let's see what these are. So here there are certain things that you need to remember, that T1 and T2 are maturity dates where T2 is greater than T1, and K1 and K2 are the strike prices. Okay, on dates T1 and on dates T2. First is call and call. Okay, what does it mean when I say call and call? So let's take a scenario. Let's say you have an underlying asset which is currently priced at 50. Okay. Now, what you are saying that I want the right to buy a call option on this asset. Okay, I want the right to buy, not the asset, a call option on this asset. So you are asking for a right to buy the derivative on an asset. Okay, not the asset itself, the difference. Okay, and this derivative is call option. Not today, at 1 year from now. Okay, so at future date. And then in the first option that you enter today, you are actually entering into an option to buy another option. Correct? So there the option price is defined. So this option that I'm willing to buy at 1 year from now, this call option, I will buy it at, let's say, $4. And this call option will have a maturity of 1 year. It will have a strike price of, let's say, $1.50, something like that. So 1 year passes, then you get to choose whether you want to buy this specific call option or not. If you don't buy, call option expires. If you buy, then you get another call option. And this call option, second call option that you buy after 1 year, gives you the right to buy the underlying asset at time T2. So for example, that I took, for example, if I continue with the example that I have taken, it was a 1 year call option to buy the underlying asset. Okay, so 1 year has passed. Now let's say the scenarios are favorable, you buy this call option, you pay $4, and now you get the right to buy the underlying asset at 1 year from now. So it's more complicated. It's derivative on a derivative. Okay, so call and call. Similarly, you can have here, you can see that, and a thing is also given, right to buy call at K1, and at K2 share can be bought using call option that you bought at this point of time. Here what you are buying, here you are buying the right, here you are buying another option to buy this call option at this time. Okay, so derivative on a derivative is a scenario. Then you can have put on call, which means you want the right to sell a call option on certain asset at 1 year from now, and that call option will have its own specification, that a certain underlying asset will be bought or sold at a specific future date. Even beyond that, at a certain specified price. Then you can have call on put, and finally you can have put on put option. Okay, so there are 4 variation of compound options. Now, chooser option. Chooser, as the name suggests, you can choose it, or it is also sometimes called as you like it options. Okay, whatever you want. So you get an option. Now it's not decided yet whether it's a call option or a put option. Okay. Certain time passes and then you get to choose, or when the maturity comes, you get to choose what option it is. Is it a call option? You want to use it as a call option or as a put option. Okay, you get to choose at maturity. That is what we call chooser option. And chooser option are mostly very, very costly because the seller of the option is always under obligation. No matter price increases or decreases, he is always under obligation. Okay, so they are very costly to put in place because you can choose, like for example, at maturity, if the strike price, if the asset price is lower than the strike price, okay, only the strike price is defined and the maturity is defined. If the asset price is lower than the strike price, you will choose it to become a put option. Okay, if let's say asset price is greater than the strike price, you will choose it to become a call option. So no matter what happens, the seller is always under obligation. So it takes a lot of cost. There is a lot of cost involved. Okay, now next, we have barrier options where there is a certain barrier that if the barrier is reached, either the option will cease to exist or the option will come into existence. So whenever you see out in the word of barrier, in any, there are 4 variations of barrier options also. And if you see a word out, it means if the barrier is reached, the option will cease to exist. And when you see an option in, when you see in the name, the word in, it means if the barrier is reached, the option will come into existence. Okay, so here it is written down and out. So here again 2 prices are specified. First is the down barrier price and the strike price. Okay, so here in the case of down and out, the barrier is set at a price way below. Okay, so let's say currently the stock price is 50, the strike price is 50, and barrier is set at 45. Okay, so it's a down and out, for example. So in this case, if the asset price reaches 45 or goes below 45, okay, then option ceases to exist. Option expires automatically. Because if it goes below, down and out means it goes down and it goes out. Okay, so goes below 45, it expires. Down and out. Down and in, if it touches 45 or goes below 45, then it comes into existence. Okay, then option comes into existence. Okay, or in other words, you can say that then the option can be actually exercised, and then if whatever happens, it has touched the barrier, then again it bounces back, no problem, it touched the barrier at least, right? Then you have up and out. Up and out means if it goes up to a certain level and breaches that level, the option will cease to exist. Up and in, if it goes a certain level, it will cease into existence. That means there will be a payoff out of this option. Okay, if it does not reaches that barrier, there will be no payoff. Okay, now options that cease to exist, for example, all the out options, down and out, up and out, they are called knockout options. That means options are knocked out after that, options cease to exist. Then all the in options like down and in and up and in, you and I. Okay, these options are called knock-in options, where the options actually come into existence if the barrier price is reached. Okay, so knockout and knock-in. Knockout means down and out, up and out. Knock-in means down and in, up and in. Okay, so these are the knock-ins. Next, you have binary options. There are 4 types of binary options. First is cash or nothing call, where what happens if, let's say, a certain the underlying is defined. Okay, so let's say underlying is a stock, to keep it simple, and the strike price is defined at 50. Okay, so in cash or nothing call, what happens if the asset price goes beyond 50? You will receive a fixed cash amount. Fixed cash, it will not vary, it is fixed cash. Okay, that is called cash or nothing call if the asset price goes beyond this level. So for example, let's say strike price is 50 and asset price becomes 70, or let's say 80. Then a fixed price that is written in the contract, let's say the fixed price written is $15. So you will receive $15. The moment asset price is breached, the strike price is breached. So if the strike price is 50 and if the on maturity, the asset price is 51 also. Okay, only $1 extra. The strike price has been breached now. So here you will have a cash receipt, and that cash receipt will be $15. Even if, let's say, asset price goes to 100, then also your cash receipt will be $15 only. That's cash or nothing call. Then you have cash or nothing put. Cash or nothing put means if the asset price is below the strike price, then you will receive a fixed cash amount. If it goes beyond the strike price, you will receive nothing. Okay, that's why cash or nothing put. Put why? Because if the prices are low, then only you will receive a cash. Okay. Then you have asset or nothing call. So if the strike price is reached, you will receive the asset. Okay, so what you are getting is assets worth. So if, let's say, today the asset is the strike price is 50. Okay, and at maturity the asset is priced at let's say 60. So you receive the asset worth 60. Then you can sell it, you will realize a profit of 10 rupees. If it is at 80, you will realize a profit of 80 rupees, 30 rupees, things like that. Okay, but if the asset price is 40 and the strike is 50, you receive nothing. That's why asset or nothing call. Okay, then you have asset or nothing put, where you will receive the asset if and only if the asset price is less than the strike price. You will receive the asset, not cash settlement. Okay, asset settlement happens here. So look back options. Next, we have the look back options. Look back options are also a type of options which we can say changing strike prices. Okay, where what you do, you at the maturity, when the maturity comes, you look back over the life of the option. So let's say option was 3-month call option. It was bought on January, and 3 months has passed. It's February, March, and April. Now it's time to expire. So you look back till January, and then using the prices which is favorable, depending on the type of options, look back option that you have bought, your payoff will be calculated. And there are 4 types. First is floating look back call. Okay, in case of floating look back, your asset price is taken for at what is at maturity, but your strike price is taken from the historical prices. Okay, so what the broker will do, he or she, that broker will look into the history over the last 3 months, and then they will identify the lowest price of that asset over this period. Okay, and that lowest price will act as your strike price, and the payoff is ST minus S min, minimum of the asset price. This is your strike here. Okay, that's why it's floating. So if the strike is changing, it's called floating. If the asset price is changing, it's called fixed. Okay, so that's the trick here to remember. Now a floating look back put, you will look at the put, you will again, asset price is fixed, ST is fixed, final asset price, but a strike price is decided by looking at the history over the life of the option. And in case of put, the maximum price is searched, because here the payoff is K minus ST. Now K has to be replaced, so you would want to replace it with as high the number as possible. Okay, or the highest number that was available for me over the life of the option. That's why S max minus ST. Now, since strike prices were variable in both the cases, okay, that's why these options are called floating options. Okay, if it was a fixed look back call, then in that case, strike price is fixed. The final asset price is not fixed. Okay, at maturity, you know that, okay, strike price is 50, but the dealer, the broker will look into the life of the option in the history over the last 3 months, and then identify what was the maximum price for that asset over this period. Let's say it was 75. So the payoff will be 75 minus 50. Okay, that's what it is called, fixed look back call. Then fixed look back put, the payoff is K minus X mean or 0. Okay, so strike price is fixed. Look into the history, find the minimum price, okay, that was available. If it is positive, then yeah, positive payoff, or otherwise 0. Okay, so that's how the payoffs are decided in look back options. Okay, now look back options are actually expensive than regular options, because you get the right first to buy the underlying asset, then to choose either the strike price or the final asset price, based on which the payoff will be calculated. So you're getting 2 rights. Okay, if it's a floating look back call, you get the right to buy the underlying asset, and you get the right to choose the strike price also. Okay, if it's a fixed look back put, you get the right to sell the underlying asset. Also, you get the right to identify the minimum possible asset price based on which the payoff will be calculated. And that's why they are more expensive than regular options. Next, we have the Asian options. These are the cheapest of all. Okay. In fact, Asian's options are the cheapest. Then you have the regular. Then you have the look back options. If you just look at the price hierarchy, that who is the costly, which is the costliest, which is the cheapest. So Asian options are cheapest, and they are heavily traded in the OTC market. Heavily traded. Okay. And their payoff is actually dependent on the arithmetic average of the underlying asset price. Okay. And they are also of 4 types. Okay. Let's see what are the 4 types. So 3 things are defined: ST, K, and S average. Average is the average stock price over the life of the option. Okay. Now you have average price calls. Okay. Where, as the name suggests, it is average price. That means the asset price is taken as average to calculate the payoff. Okay. Similarly, for average price puts, again, the asset price is taken as the average. If you have average strike calls, then strike price is taken as the average, not the asset price. And if you have average strike puts, again, the strike price is taken as the average, but the asset price is not. So there are 2 types, price and strike. If it is average price, asset price, ST will be replaced with S average. If it is average strike, K will be replaced with S average. Okay. Everything else, depending on the nature, be it call or put, you can calculate the payoff. If it's called, formula is ST minus K. If it is average price call, it will become ST will be replaced because it is average price. So S average minus K, and so on. You can just apply this logic and identify the payoffs. Okay. So these are the tricks, small tricks that you can keep in mind. Average price calls means price will be taken as the average, asset price. Average strike means strike price will be taken as the average. Okay. Now, you see, averages are less susceptible. They are less volatile over time. Okay. They are more stable. So even if there was a huge, significantly large asset price, so if you average it out, its impact is dispersed over the 3-month period. So they give you an opportunity to vary the strike price or the asset price depending on the nature of the Asian option that you have bought. But an important thing to understand here is that the impact of this thing on the payoff is not too much. Okay, there is some impact, but not too much. Okay, since the average prices are being taken. So that's why these are considered the cheapest. Okay, and you will find for this reason that Asian options are the cheapest. Then you have the regular vanilla options, plain vanilla options, and then finally you have the look back options, which are the costliest. Okay. Other 2 variations of this exotics are volatility swap and variance swap. In fact, these 2 are related. Volatility swap is a forward contract where we agree, the 2 parties agree. Actually, it's a swap. Okay. One volatility is exchanged for another. A notional principal is defined and a fixed volatility rate is defined. It's very similar to a forward contract where a forward price is specified. Okay. So here, since volatility is the forward is taken in the forward time, so you need to have certain principle on which the amount will be calculated that can be transacted. Okay. So the formula is like there are 3 parameters: L vol, that is the principal, notional principal for volatility. Okay. For volatility swap, then you have sigma K, the fixed volatility. Then you have the sigma, that is the realized volatility at maturity. Okay. At 1 year from now. The fixed pay is if you buy a fixed pay volatility swap where you will pay fixed and receive the float. So here you are receiving the float, paying the fixed. So simply the payoff is L vol times sigma minus sigma K. Okay. You receive floating, pay fixed. Okay. Sigma K is the fixed, you are paying it. That's why minus sigma K. Then you have fixed receive or um, uh, uh, you can say realized pay. Okay, fixed receive or realized pay. Fixed receive, that means you're receiving fixed and paying the realized one. Okay, so this will be your payoff in this case. Okay. So that's how things are decided. Now here, payoff can be positive or negative also, depending on what the realized volatility is when compared to the fixed volatility that is defined on the volatility swap. Next, you have the example. Here, you have the principal amount which is defined on the, and the volatility, yearly volatility on the S&P 500 index is taken into consideration. Okay, over a 3-month period. It is expected that fixed volatility is 15%. Realized volatility turns out to be, actually it should be 10%, I think. Oh, sorry, 1%. Realized daily volatility is 1%. So you can convert it into yearly volatility at 3 months from now. So it turns out to be 15.87%. Now, what are you? You are receive fixed. That means sigma receive fixed. You will be receiving fixed. So it is sigma k minus sigma. Okay. So here you see your payoff is sigma k minus sigma. You are receiving fixed, paying realized. So you are receiving 0.15, paying 0.1587. So for you, here you will have a negative payoff, which is minus $8,745 payment that you will have to make. Okay. Then finally, we have the variance swap. Variance swap is basically an analogy of volatility swap, because we know that variance and volatility are related, right? Volatility is simply the standard square root of variance. Okay. So here it's simply the variance principle is defined, notional principle. Divesh, it was not a 3-month period. You see, they are actually betting on the yearly volatility at 3 months from now. That what the yearly volatility will be at 3 months from now. Okay. So once the 3-month passes, the yearly volatility, it was found that the daily volatility is 1%. So you find what the yearly volatility is. Okay. Yeah. Now, here the variance is considered, everything is fixed. Everything is same. Okay. Sigma square minus VK. VK is the fixed variance and sigma square is the realized variance. Okay. Here, if you are received fixed, you are receiving VK, paying the realized. If you are pay fixed, it will be sigma square minus K, just the opposite. However, there is a relationship between the notional of volatility principle and variance principle. And these are the relationships. And in fact, I would say just keep this thing in your mind, especially this formula, that what is your volatility notional. Sometimes in the question, you will find that variance notional is given and they would ask you to find out the volatility notional. Okay. So this formula can be employed to find out the volatility notional or the opposite variance notional. But in order to do that, you need to know what is your fixed volatility. And of course, fixed volatility can be found. Fixed variance is given. Just take the square root of that. You get the fixed volatility. Then you have the volatility principle. Okay, you divide it with the fixed volatility and 2. Okay, you get the variance principle. End of the story. Okay, so that's the end of the lecture. Now I'll start with the next chapter, that is VRM 14, binomial trees. So just give me a minute, I'll share the next slide. Yes, so now we're going to start with VRM 14, that is binomial trees. Now in this chapter, we are going to see how the options are actually priced. Okay, so in the previous chapters that we were discussing that were related to options, be it properties of options or options market, there we talked about the bounds of prices. That means on any day, what is the maximum price or the lowest price within which the option price can fluctuate. Okay, within which the option value can fluctuate. In the chapters that we are going to study from now onwards, that is this chapter and the chapter after that, that is BSM model. Okay, we will actually see how the exact option prices are calculated if we know the parameters. Okay, so first chapter under our consideration is the binomial trees. Okay, where we apply the binomial tree method to find out the price of options. And this method, binomial tree method, is applicable to both American as well as European style options. We can find the value of any options using binomial tree method. Okay, so let's start our discussion. And there are two things important to understand. In fact, it is true for any derivative pricing. First is the no arbitrage argument. That means if there are two portfolios providing the same cash flows, they should share for the same values. Okay. And which is also called the law of one price. And finally, the risk neutral valuation. For derivatives, it is assumed that the market is risk neutral. It is a hypothetical scenario where it is assumed that the market is risk neutral. And when risk neutral scenario is used to find the value of the derivative, it actually fits into the risky world also. Surprisingly, there is no actual reason, valid reason given for that why this happens, but it happens. Okay. And that's why risk neutral valuation is used, where it is assumed that the expected return on any asset is nothing but the risk-free rate. Or in other words, investors are insensitive towards the risk. They do not perceive risk as risk. Okay. Whatever the risk, the return they are expecting is the risk-free rate of return only. However, we know that in practice, it doesn't work. Okay. But for derivative pricing, it actually works. Okay. It actually works. And that's why risk neutral valuation method is applied. Now, let's understand one-step binomial tree method. So here I have taken a very simple example where we have a non-dividend paying stock, which is currently priced at stock price S. Okay. That's the price today. And the option has a time to maturity of time t. And over this time, it is expected that the stock price can either move up to a new price, that is SU, okay, which is calculated as S times U, where U is the up factor. Okay, it is called the up factor. So for example, if we are saying that the stock price may go up by 20%, so up factor will be 1.2, okay, and the return in this case will be 20%, that is the factor by which the stock price will increase, is expected to increase. Or it is also expected that it can go down to SD. It can decrease also by a down factor D. Okay, and SD is nothing but current price times the down factor. So let's say we are expecting that the stock price will go down by 20%. So D will be 0.8 in this case, and my return will be minus 20%. Okay. Now, given these scenario, let's consider a derivative that will provide a payoff of FU if the stock price increases. If the stock price is SU, the payoff is FU. Okay. And if the stock price is SD, the payoff from the derivative is FD. Okay. So this thing is given. Now let's take a simple scenario, stock price. This is today's scenario, S. Then you have up scenario, stock price goes up, and for the sake of convenience, since we are talking about options only, so here the derivative under consideration is option. So option payoff is FU. Then second scenario is that it can also go down to SD. So in that case, my payoff will be FD. Okay. So this is the scenario. And you might be wondering that this pricing model is actually called binomial pricing model. Okay. Binomial tree pricing model. Can anyone, I'm just asking, just one question that I'm asking throughout the class. Okay, can anyone tell me why this option pricing model is called binomial? Why this option pricing is called a binomial tree model? Any guesses? Any idea? Exactly. Two outcomes, two deviations, and iterations. So no matter how many iterations I have, over the next period, the number of outcomes that I have is 2. Okay, that's why it is called binomial. You can have trinomial tree also. Always remember, in fact, more complicated models do exist, and there can be trinomial tree scenario where you can have 3 outcomes. And I can argue that, okay, there are 3 scenarios possible. Stock price goes up, stock price goes down, stock price does not change. Okay, so in that case, it will be considered a trinomial tree method. Okay. However, trinomial tree method is just like this only. Just one extra step is added, so it adds to more complexity, be it mathematics, be it formulas, everything. So that's why binomial tree is the most appreciated method, most widely used method. Okay. In fact, in the part 2, let me tell you, for term structure models, you will study binomial tree once again to build the complete term structure and then find the bond prices. Okay. So that's a story for your part 2. First, let's focus on part 1. Okay. So, yeah. So this is the scenario here. Okay. Now let's make it more simplified. We are interested in the derivative only, right? That means FU, FD, and what is the value of this derivative today? I know the value of the derivative at maturity, at time t. That is that it is either FU or FD. Okay. Now let's take a very simple assumption that there are 2 outcomes. Okay. So there has to be a probability that the stock price will go up, and there has to be a probability that the stock price will go down. If and only if I know the probability of stock price going up, naturally I'll know what is the probability that outcome that the stock price will go down. I'll naturally know it. Okay, it's 1 minus P. If P is the probability of price going up, 1 minus P is the probability of price going down. That's another simplicity that we get from binomial tree. Okay, and this simplicity is not available in case of trinomial. So usually you will not find people using trinomial. Okay, in fact, nobody use it. Okay, there are models but exist. Okay, there are models, trinomial models which exist. So if and only if I can estimate what the probabilities of these things happening are, I can actually find the expected payoff at maturity. Okay, 2 outcomes are there. I have 2 probabilities. I can find the outcomes. Bernoulli variable, we have studied it. It is outcome 1 times probability of 1 plus outcome 2 times probability of 2. End of the story. Okay, then I want to find what is the value today. So I'll just discount the expected payoff to today. Okay, taking the present value of expected payoff. That's the whole objective here. Okay, and that's what we are going to do in the upcoming slides. So here, first, let's consider the two outcomes only, relevant outcomes, FU and FD. I want to find F. First, I will find the expected payoff at maturity. Then I will discount it to today. That will be my F. Okay. And you see the same thing has been done here. If you look at the formula carefully, this is the expected payoff. I just want to know one more thing, that is probability. That's all. Okay. And also probability can be calculated analytically. Okay. It has been derived. Derivation is not important. The formula is important. So P times FU, that is the probability of stock price going up, times the payoff when it goes up, 1 minus P times FD, that is probability of stock price going down, times the payoff if the stock price goes down. This is the expected payoff at maturity. Then you discount it till today and you get the F. Okay, end of the story. Okay, that's one step binomial tree. Now the only thing that is required is the value of P. I already have FU, FD. I know the risk-free rate. I know the time to maturity. I need to find P. So P is calculated using this formula. If it is a non-dividend paying stock, of course, E raised to the power of RT minus D divided by U minus D, where D is the down factor, U is the up factor. Okay. In the previous example that I took, I said 1.2 as the up factor and 0.8 as the down factor. So you can use them. R is the risk-free rate and T is the time to maturity. If let's say it's 6 months or 3 months or 1 year, whatever. Okay, you can calculate the value of P. Once you get P, you can then identify F quite easily. Okay. Now, let's move forward. And let's see a simple example of one-step binomial tree. So let's say we have a 3-month European call option on a stock which is currently priced at 50. Okay. Let's say our R is 3%, up factor is 1.2, down factor is 0.2, 0.8, and K is $52. Strike price is given to me as $52. Okay. Now, I want to find FU. FU means stock price goes up. So 50 times 1.2 is 60. And my payoff will be ST minus K. It's a call option, right? So ST is 60, K is 52. 60 minus 52, that is 8. Then FD, that is payoff when the stock price goes down. Down factor is 0.8. 50 times 0.8 is 40. If the stock price is 40, call option is not exercised. Call option is let to expire. Payoff is 0. Okay. Now I have FU and FD. I just need to find the value of P. P is given as E raised to the power of RT minus D by U minus D. So R is given, T is known to us 0.25 years, D is given 0.8, U is given 1.2. It's simple mathematical calculation. We do it, we find that P is 51.81% or 0.5188. This is something that we'll use. Yes, Divesh, I'll come to that point once I have explained the binomial tree model, that what kind of questions you can expect from this chapter. In fact, there are a lot of surprises, let me tell you. So have patience just for a few minutes. Okay, Divesh. Yeah, so P I have found out. Next, I'll find 1 minus P, that is 0.4812. Now finding F is quite easy. Okay, all I need to do is apply the formula that we have studied earlier. Okay, so here it is 8 times FU times P plus FD times 1 minus P. And it is discounted for today. We get 4.12 as the value of option today. Okay, now the problem in the case of one-step binomial tree is that if the time period is 3 months from now, we can say for sure that there are not, that we can't only have 2 possible outcomes. We can have multiple possible outcomes. Okay, so what's the way out? Should we branch out at multiple nodes from this point, or is there any other way? Is there a way that we can extrapolate this binomial tree method and we can increase the efficiency of price estimation? So yes, there is. Actually, we can extrapolate the binomial tree method by reducing the period between the nodes. So let me tell you what the nodes are very quickly. Okay. I'll have to go back to this one. So here you see these boxes, right? These boxes are nodes. Okay, so here this is time 0. This is at time period 1 or T. Okay, so here we have only one node. Okay, and 2 boxes. Okay, so if I reduce the gap between these nodes, so from node A to this box, these 2 boxes, if I reduce the time period, I'll increase the efficiency. At maturity, I'll have multiple boxes available, multiple possible outcomes for the stock prices. Okay, so that's what we do in the case of multiple step tree or multi-step tree. Now, for the sake of simplicity, in fact, from the examination perspective also, if I say you will at max see two-step binomial trees, okay, where you'll have to do any kind of calculation, that will be at max related to a two-step binomial tree, not even three. But in practice, okay, in practice, when people actually work with the binomial tree model, they use a minimum of 100 steps. Okay, a minimum of 100 steps. It can go up to as high as 1000 step depending on the maturity also, but a minimum 100 step has to be taken. Okay, so here in this case, what happens is that we just manipulate the previous formula. So the time, let's say option is a 3-month call option, or let's say 6-month call option. And now I want to increase the number of steps. I don't want to jump directly from 0 to 6 months. I want to take 2 steps to go there. So one step I'll reach, in one step I'll reach at 3 months, then another step I'll reach at 6 months. By doing so, I'll have 3 possible stock prices at 6 months from now. Okay, now if you increase the steps, what will happen? The number of possible stock prices at maturity will increase, thereby increasing the efficiency of your option payoff at that point of time, and finally the option value today. Okay, so the catch here is to replace the time, which was t in the previous slides, with delta t. And delta t is decided based on what? Based on the number of steps and the time period. So if let's say time period is 6 months and you want to take 2 steps to reach at 6 months, so your delta t will be 6 divided by 2, that is 3 months, or 0.25. If you want to take, let's say, 6 steps to reach there, so it will be 6 months divided by 6, that is 1 month. So each step is 1 month long. Okay, and then recursively you build a tree which will be very lengthy. And at each step you find the value. Okay, it's a backward induction process. I'll explain it in the upcoming slides with an example. Probability formula is again manipulated, because in the probability we had e raised to the power of RT, which is replaced with delta t. And also up factor and down factor are something which is really important to know. So these up and down factors are calculated using the annual volatility of the underlying asset. So if my annual volatility is known, that it is sigma, then I can calculate the up factor using the formula e raised to the power of sigma square root of delta t, and down factor as e raised to the power of minus sigma square root of delta t. And d can also be calculated as 1 by u. Okay, there is another formula also. If you have calculated u, just take the reciprocal of d, you will get, if you have calculated u, take the reciprocal, you will get d. If you have calculated d, take the reciprocal, you will get u. Okay. And always remember, time has to be measured in years. Never keep it in months. Even if the step is 1 month long, divide it by 12, 1 over 12. Okay. You have the calculator. What's the problem if the number is in decimal? There is no problem. Okay. Use the calculator, do the calculations. Okay. Now, let's see an example and let's understand how option pricing is done. So for the sake of convenience, we have taken an example here where we have a non-dividend paying stock, and currently it is priced at 29. It has an annual volatility of 25. Okay. And it's a European call option. Okay. We want to find the value of a European call option on this asset, which would have a strike price of 30, which would have a life of 1 year. Okay. That means T is 1 year. And it's a 2-step tree, because we are talking about 2-step only. So delta T is how much? 1 year divided by 2. That is 0.5 years. Okay. Delta T is 0.5. And the continuously compounded risk-free rate is 3% per annum. First thing first that you have to do is to find all the necessary parameters, relevant parameters. First is delta T. Okay. Delta T is 1 year divided by the number of steps you are taking. So 1 by 2, 0.5 is your delta T. Next is up factor, sigma square root of delta T, e raised to the power minus 0.25 times e raised to the power of 0.25 times 0.25. Okay. You get 1.1934. Then the down factor, 0.8380. Okay. Then the p value. Okay. This is the probability of stock price going up and down at each step. Okay. It is 0.4984, and then finally 1 minus p, it is 0.5016. Relevant parameters have been calculated. Now what we will do, we'll build the binomial tree. First step is to build the stock. So first step, here I already have the boxes. So these are I have given the names also, so that when I show you the calculations, you're not confused as to which node I'm talking about. Okay. So there are 2 steps now. From A, I go to 6 month, 2 outcomes. From B, again 2 outcomes are possible. From C, again 2 outcomes are possible. Now one would say that there should be 4 here, because from C also 2, from B also 2. But if you look at it carefully, it's up and down. So you go up and you go down by same amount. Okay. So what's your change? You are at the same place, right? Here also it's down and up. Again, you're reaching at the same place. However, in the this is a very simple model where we call it recombination binomial tree model. Okay. There are certain binomial tree models that you will study in part 2 which do not recombine. So in those cases, you will have 4 outcomes, D, E, F, G. Okay, but in the case of options, we usually use recombination binomial tree and we have 3 outcomes. So there will be 2 outcomes combining. Okay, now next step is to find the stock prices, possible stock prices at all nodes A, B, C, D, E, and F. Okay, so this is done. 29, then it goes up, it becomes 34.608, it goes down, it becomes 24.302. How it is calculated? 29 times the up factor for down price, 29 times the down factor for C. Okay, similar calculations can be done for B to D, B to E, and C to E, and C to F. Okay. Once I have the stock prices, now my task is to find the payoff at maturity. No other payoffs are calculated. Okay. Payoffs are calculated at maturity. And remember, it's a European call option that we are valuing. Okay. It's a European call option. So first at D, E, and F, we will find the payoff. And why it is easy? Because this is the maturity. And at maturity, I can exercise the option. So I know for certainty that if this is the price, what will be my payoff? If this is the price, what will be my payoff? If this is the price, what will be my payoff? Okay, so I do that. Strike price was 30. So it is 41.301 minus 30, which is 11. Here it is 29. Again, 0, 20, 0. No problem. Now let's go back. Okay, now this step that I'm taking back. Okay, so once I have the DEF, so for example, I want to find out what will be the value of option at node C. Okay, so I will take the expected value of payoffs at node E and F and then discount it back to point C. This process is called backward induction. Okay, now what I have to do is backward induction. So since at node E and F both, the option payoff is 0. So no matter which formula you apply, the option payoff at node C will also be 0. Okay. Now the task is to find the payoff at option B, because at one node we have a positive payoff, at other we have 0. So we'll have to apply the formula that we have studied. Okay. So the formula was e raised to the power of risk-free rate times delta t times fu times pu plus fd times pd. Pd means probability of down, that is 1 minus p actually. So when you carry out the calculation, you get the number as 5.549. Okay. Now this is done. Now you will find, again, you do a backward induction once more to find the value at node A. Okay. Here you have 2 outcomes, 5.549 and 0. You take the step back, use the same formula. Okay. But here fu, payoff of a stock price up is 5.549 and payoff at stock price down is 0. Okay. Apply the formula. You get the value as 2.724. This is your call option price. It's a 2-step tree. If you want to increase the estimation accuracy, increase the number of steps. That's the only way out here. Okay, you can make 10, 20, 30. The moment you keep on increasing the step, you will see that these numbers will change and it will become more and more precise. Next, we need to understand how American options are valued. So for European style options, it was quite easy. Okay, you had to just find the payoff at final nodes, then do backward induction until you reach the first node. That will be the value of the option. Okay. In American option, there is a slight variation. Okay. Slight variation. And the variation is in at each node, you have to find out 2 things, except for the final. For the final one, it's the final payoff that you do. Okay. For the final one, it's easy. You find what will be the payoff at final node by using the formula max of st minus k or 0 if it's call, or max of k minus st or 0 if it's put. Okay, final node. We're talking about node A, B, and C that we saw previously. Okay, so at each of these nodes, you will first see what is the value if the option is exercised at that node. Okay, and second, what is the value if the option is not exercised? Not exercised means you will do backward induction and find the value. That is the value if the option is not exercised. And if option is exercised, simply just find what is the difference between the strike price and the payoff. It's an American style option. It can be exercised. It could be exercised actually. Okay. These two calculations are done, and then the greater of these two calculations are taken into the calculation, are taken into the finding option price. Okay, so if let's say you find, hypothetically, let's say that at node C, you do backward induction, okay, and you find the option payoff to be, that is the no exercise payoff, precisely, option payoff to be 2.4. Okay, and then you find the payoff if the option is exercised. Let's say it turns out to be 3.5. So the greater of these two is 3.5. So you will take 3.5 as the value at that node, not 2.4. Okay, 2.4 will be discarded. Now let's take an example and let's understand. It's again pretty easy to see how these things work. Okay, so first and foremost, build the tree, build the stock prices, then calculate the actual payoff on exercise. Okay, because it's an American style option. So you need to know the actual payoffs of exercise. Okay, so it's a put option, you see, it's a put option. Everything is similar to the last question except that it's a put option. Okay, so 41.301, strike price was 30. It will not be exercised, 0. Asset price is 29, strike price is 30. Exercised, payoff is 1. Asset price is 20.39365. Strike price is 30. Exercised, payoff is 9.635. Okay. Now, at node B, asset price is 34. Strike price is 30. Not exercised. Payoff is 0. These are when we actually exercise the option. Okay. These are not the backward induction payoffs. Then at node C, we exercise the option and the payoff is 5.698. And then finally at node A, we exercise the option and the value is $1. Okay, so this is the calculation that I have done. This is not final. Okay, I have to find the backward induction values for node A, B, and C as well. Okay, then I'll do a comparison. Then finally values will be taken. Now, for node C, if not exercised, it will be 5.252. How? We have used the formula e raised to the power of minus RT times FU times P plus FD times 1 minus P. Okay. Based on that formula, the price turns out to be 5.252. And in the previous slide, we saw that if I exercise the option at node C, my payoff will be 5.698. Okay. So since 5.698 is actually greater than 5.252, option will be exercised at node C, and the payoff from the option, the value of the option at node C will be 5.698 and not 5.252. So backward inducted value of the option is discarded here. Okay. Next at node B, if it is not exercised, the payoff turns out to be 0.4941. And if it is exercised, the payoff is 0. We saw it in the last slide. Asset price was 34, strike was 30. Option is not being exercised. But if I find the backward inducted payoff, it is 0.4941. Now, since 0.4941 is greater, so option is not exercised at B, and the value of the option at node B is 0.4941. Then finally, we do for option A. If not exercised, backward inducted price is 3.058. Again, here I have shown the formula, how it is being calculated. And if exercised, the payoff is 1. So I will not exercise. Okay, and the value of the option will become 3.058. Okay, 3.058 is the value of the option. So that's how we do for American style options. Okay, just slight variation of the European style. Now let's come to the point where you may think that what kind of questions can be asked from this chapter. So frankly speaking, variety of questions. Okay, they may ask you to find up factor, down factor, probability. Pretty simple. Okay, they may also give you a tree. Okay, where one of the prices will be missing, and they may ask you to find out what will be the value of the option at that specific node. Okay, for a specific node. And if your luck is very bad, then they may give you a question where you will have to find the final option price. That means you will have to build the complete binomial tree. Okay, and I will say for sure that because we have been talking to a lot of candidates in the past, and they have, based on that, I'm basing my argument that they have told me that for some candidates, there were papers in which complete binomial tree construction was asked. Okay, so be prepared for that. However, there can be questions. Other candidates also said that, okay, only certain calculation for certain nodes were asked. Everything else was given, or maybe only calculation of P was asked. Yes, Divesh, two-step is time consuming. So you need to be very, very efficient on that. Practice 6-7 questions around this. Okay, you will be confident enough. Okay, now let's see the final tree. So this was our final tree. These were the stock prices and these were the final payoffs. Now you see the difference. Here we have taken the backward inducted value. Here we have taken the actual payoff. And then here again, we have taken the backward inducted value. Why? Because those were the greater numbers. Okay. Whatever is greater, we will take that. And finally, we get the price. Okay. Now, if we talk about other assets, so the discussion that we were having till now was on the non-dividend paying stock. But if let's say you have a dividend paying stock, for example, where you have an asset which pays a dividend yield, or let's say you have asset which is an index which pays again a dividend yield. Okay, so in that case, only the formula of P changes. Everything else that we have studied so far stays the same. Calculating F, calculating payoffs, backward induction, taking the greater of 2 if it's the American style option, everything is same. Only the calculation of probability changes and it becomes e raised to the power of r minus q, where q is the dividend yield times delta t minus d by u minus t. Even the calculation of u and d is the same, sigma root delta t. Okay, e raised to the power of sigma root delta t for u and e raised to the power of minus sigma root delta t. Okay, for option on currency, foreign currency is considered as an asset which is providing an interest at the rate of foreign risk-free rate. So again, the probability formula changes as e raised to the power of r minus rx. Now here the catch is you need to identify clearly what is the foreign currency. Okay. Next, you have option on futures. Now on futures, probability formula is the easiest, 1 minus d by u minus t. Why 1? Because futures are derivatives. And we know that for derivatives, we assume risk neutral valuation. Okay. Risk neutral valuation means the return on the asset is risk-free rate. So your dividend yield in this case is R. So e raised to the power of RT, what was the formula? If you have a dividend yield, e raised to the power of R minus Q, where Q was the dividend yield. Now here the dividend yield is equal to R itself. So it becomes e raised to the power of R minus R. That is e raised to the power of 0. And any number raised to the power of 0 is 1. And that's why for futures, we have probability formula as 1 minus d by u minus t. That's the only catch here. And with this, we end this chapter. Okay, so that was all of it. The takeaway from the chapter is that practice questions, 4-5 binomial trees, preferably build 2-step binomial trees so that you have that confidence in the examination. Do a lot of calculations related to P, F, U, D, everything on the calculator, so that when you are doing calculations in the exam, you have the confidence that you are doing the right calculations. Okay. Use calculator as much as possible. Never do it orally or using pen and paper. It's time consuming. And at the same time, the chances of making mistake is also high because during the exam, you are under pressure. Okay. Nobody realizes it, but when they're practicing questions, candidates feel like, okay, I'll do it right now. But when you are not in the examination, you are not feeling that pressure. Okay. But when you sit in the exam, it's completely different scenario. Okay. Because there you have to perform. There is no way out. So that's the takeaway. Just give me a minute. I'll share the next chapter. Yes, guys, please confirm if you can see the BSM model home screen. Okay. So let's start. And now we are moving towards Black-Scholes-Merton option pricing model. In short, BSM model. Okay, it's used to price option. So first in this chapter, what we're going to do is to understand the basic assumptions based on which BSM model is built. Okay, of course, we are not going to dive into the mathematics behind it. In fact, it's not a part of the FRM curriculum also. So in any case, we were not going to do that. But in the crash course, because of time constraint, of course, I'll not be doing that. So the basic thing that I'll do is I'll explain the assumptions, that what are the assumptions related to the stock prices, the stock returns, everything. And then we'll directly move to the pricing formulas, because in this chapter, trust me, the pricing formulas are important and you need to memorize this formula. If I talk from the point of view of examination, they may ask 1 or 2 questions where they will give you to find the call option price, put option price. And of course, there is a high chance that they will give you the value of D1 and D2. And D1 and D2 may also be given. And if they are not giving it, they will provide a separate normal distribution table where you can look for the CDF values corresponding to that D1, D2 values. Okay. So let's start our discussion on BSM model. Now, first thing that we're going to understand is the stock price movements. Okay. So first, the BSM model actually assumes that the return on a non-dividend paying stocks over a short period of time, short, very short. Okay. In fact, theoretically, this short period is infinitesimally small, or delta t tends to zero. I said tends to zero means it's not exactly zero, it's moving towards zero. At exactly zero, it's like no return is possible. Okay. So it tends to zero. When the time period is tending to zero, then the return distribution is normally distributed. Okay, that's the ideal assumption. And if mu is the mean return and sigma is the volatility, and if let's say these are annual, then return in time delta t, which is a small time delta t, maybe 1 day, 1 week, something like that. These are small times, is assumed to be normally distributed with a mean of mu delta t if it is 1 day. So delta t will be how much? 1 over 252. And if annual return is 15%, so it will be 15 by 252, your daily return. Okay. And standard deviation, sigma root delta t. Because variance is something which will be multiplied with delta t, not standard deviation. Standard deviation is square root of variance, and that's why square root of delta t. Okay. Theoretically, this is true only when delta t tends to zero. But in practice, it is approximately true for a small delta t. Small delta t means 1 day, at max 1 week. Okay, 1 week is considered a small delta t. But most of the time, in fact, in finance, almost everywhere you will see that returns are calculated on a daily basis. Okay. Now, stock price movement example. So here's a simple example of that assumption has been shown that let's say today the stock price is 100, has an annual mean return of 12% per year and the annual volatility of 25% per year. Okay. And the probability distribution for stock return over 1 week is approximately normal. So for me, it is given that delta t is 1 week. Delta t is 1 week, or in other words, in years, if I convert it, it will be delta t equals to 1 over 52, because in a year we have 52 weeks roughly. Okay. Now let's say I want to find out the 95% confidence interval for the stock price. Okay. Over 1 week, not over 1 year, but over 1 week. Okay. Weekly stock price. So how will I do that? First, I will identify what is delta t. It is 1 over 52. Then I'll find the mean over 1 week, that is 0.23%, and then the standard deviation over 1 week. Once I have these things, I know that weekly returns are normally distributed. The confidence interval formula, let's say if it is 95%, so my critical values will be 1.96, and the formula will be mu plus minus 1.96 times standard deviation. So here mu minus 1.96 times standard deviation, 2 mu plus 1.96 times the standard deviation. We get the return values at minus 6.6% to 7%. So these are the bounds, upper and lower bounds, which I'm 95% confident that this will happen over the next 1 week. These will be the returns. So what is the bounds for stock prices? I have the returns. I can calculate the stock prices. 100 minus 6.6% to 100 plus 7%. So that is 93.4 to 107. Okay, this is the price range for stock price over 1 week. Okay, that's first assumption. Second assumption says log normal distribution. Second assumption talks about log normal distribution. Okay, it says that when return on a stock over a very short period of time, for example, 1 day or 1 week, is normally distributed, which is usually the case. Okay, over 1 day, of course, most of the time you will see that the returns are normally distributed. Okay, for most of the financial assets. Then stock price over longer periods of time are log normally distributed. What are its implications? Let me explain that. So it means that if let's say I know that daily returns are normally distributed, okay, I can establish that fact. There are multiple ways to establish it. Okay, you can collect daily returns data and then you can conduct the Jagbera test, for instance. Okay, and most of the time for most of the assets, daily returns will be normally. Okay, slight deviations can be there. Then you can, if that is not working, unconditional normality, then you can go for conditional normality. Conditional normality is something which always work, because if I know the volatility, then I can say that the daily return is normally distributed with even more confidence. We have studied these things in VRM chapters. Okay, initial chapters of book 4 only, valuation and risk models, market risk chapters. Okay, initial VRM 1, 2, 3, chapter 1 to 3 of book 4, conditional normality and all of these. So if it is established, then stock price over longer periods, like stock price at 2 years from now or at 3 years from now, these stock prices will follow a log normal distribution. And if I am able to say that, okay, stock price over longer periods are log normally distributed, then I can find out what is the confidence interval for the stock price at 2 years from now. Okay, what will be the possible values of stock price at 2 years from now? That is something that I'll be able to established today. Okay, that's the benefit of this assumption. And why it works, log normal assumption works for future stock prices, because we know that future stock price can never be negative. At worst, it can become zero, but stock price can never be -1, -2, something like that. And that's the biggest reason why we impose log normal distribution on stock prices. Okay, because for log normal distribution also, the most important assumption is that the values are non-negative. It means it can be 0 or greater than 0, but not less than 0. Okay, next. If we talk about the formula, because once I have established that stock prices are log normally distributed, I need to find out the expected stock price, expected log normal stock price, and things like that. Okay, so how do we do that? So for that, let's say that the standard deviation of change in the stock price is S in time delta t, and S sigma root delta t. And of course, sorry, this is the reason why a stock price cannot be negative. Okay, this is the reason why stock price cannot be negative, and it is given mathematically. Why? Because even if, let's say, volatility increases and the stock price falls, okay, so volatility is in percentage terms. So if, let's say, 20% is the volatility, sigma root delta t is 20%, let's say. So stock price falls by 20%. And let's say it goes to from 100 to 80. Okay. Now again, let's say there is a fall of 40%, but this fall is from 80 rupees, not 100. So even if it's a fall of 40%, the fall is only limited to $24. Okay. Then as the stock price decreases, the decline in the price because of the volatility also decreases. Okay, and that is the reason stock price can never become negative. Okay, so the lower the stock price become, the smaller the movements become because of the volatility, and that's why the stock price can never be negative. That's the mathematical explanation. And there is, of course, an intuitional explanation. We know that stock price can't be negative. Okay, stocks give us the ownership. Okay, so I have the shares. Okay, now the max that I can lose is the money that I have invested. I can't lose more than that. Correct. So that's a layman's logic, you can say. Now let's define certain things. If, let's say, S0 is the stock price today at time 0, ST is the stock price at time t, which is longer period, let's say at 2 years, 3 years, something like that. So expected value of ST, EST, is given as S0 e raised to the power of mu t, where mu is the average return. Okay. And the expected value of logarithm of a stock price, E of ln ST, is given by this formula. Now you see, one might argue that, okay, why not E of ln ST is simply I take the ln of this number and just find the expected value of that. We know that logarithm is not a linear function. And in quantitative analysis chapters, initial chapters, I think QTA 3 or 4, you might have studied that Jensen's inequality, which says non-linear operators cannot pass through expectations. Okay. So that's the logic. And due to that, there will be some deviation. And this is that deviation that is under consideration. Okay. Mu minus sigma square by 2 times t. Okay. Where mu is the stock return, sigma square is the variance of the stock return. Okay. Over longer periods. So E of ln ST is nothing but ln of S0 plus mu minus sigma square by 2 times t. And these are yearly, mu and sigma. Standard deviation is simply given as, standard deviation of ln ST is given as sigma times root t. Now you see, we have established the fact that ST is log normally distributed. So I can say that ln of ST is normally distributed. That's the basic definition of logarithmic distributions. Like we have studied it, log normal distributions. We have studied it in QTA 3, log normal distribution. Okay. So if ST is log normally distributed, E of ln ST, ln of ST is normally distributed with a mean of this and a variance of, or a standard deviation of this. Okay. Now you need to understand the difference, that ln of ST is not the same as return distribution. Return means ST by ST minus 1. Here, in case of return, the logarithm of the stock price ratio is taken into consideration. Here, the logarithm of stock price is taken into consideration. So ln of ST is not the return distribution. Be clear. Okay. ln of ST is not the return distribution. It's simply logarithm of a stock price distribution, which is normally distributed. Now, let's take an example and let's see how we can build the confidence interval over longer horizons. So in the previous example, we had the stock price of 100 annual mean return of 12% and volatility of 25. Now we want to construct the confidence interval for stock price at the end of 2 years, not today. That what will be the confidence, how confident I am, what is my 95% confidence interval for the stock price at 2 years from now, not today. So for that, we need to find the, we know that stock price over longer periods are log normally distributed. So first I need to find out the E of LNST and sigma of LNST. Because we know that ln of st is normally distributed. If st is log normally distributed, ln of st is normally distributed. Okay. So normal distribution confidence interval, I can easily find it out. Then I can just transform, okay, to find the stock prices. So first I find the E of LNS. It turns out to 4.783. This is not percentage returns. I'm again telling you, these are not return values. Okay. These are ln of s, not ln of s by s minus 1. S by s minus 1 ln is the logarithmic return. These are just the logarithm of a stock price. Then you find the standard deviation. Of course, the standard deviation can be in percentage terms. It is 0.354 or 35.4%. Now I want to build the 95%. First, I'll build the 95% confidence interval for ln of s. Okay, I'll find the confidence interval for logarithm of s, because logarithm of s is normally distributed. It's easy to find. I can apply normal distribution assumption. That is mean minus 1.96 times the standard deviation and mean plus 1.96 times the standard deviation. Okay, I build the confidence interval for ln of s. Now I have to find the confidence interval for s. So I take exponent on both the sides. E of 4.0980892, E of ln of s2, E of 5.4768. So E of ln of s2 is nothing but s2. Okay, that is at 2 years from now. So this turns out to S2, and we just solve these two numbers and we get 59.6921 and 239.0804. Okay, so this is my confidence interval of a stock price, 95% confidence interval of a stock price at 2 years from now. Okay, so these are the two most important assumptions. Other assumptions are quite similar to what we have for capital asset pricing model. Okay, risk neutral valuation, what we studied for binomial tree, is applicable here also. Okay. Now the pricing formulas. If let's say you have a non-dividend paying stock where the strike price is K, time to maturity is T, risk-free rate is R, and the annual volatility is sigma. Okay, then call price and put price can be calculated using these two formulas. Okay, S naught N D1 minus K e raised to the power of minus RT N D2, and P is given as K e raised to the power of minus RT N of minus D2 minus S naught N of minus D1. Now what are these D1 and D2? Values are calculated quite easily. D1 is given as ln of S naught by K plus R plus sigma square by 2 times T divided by sigma root T. That's your D1. Okay. D2 is again a very lengthy formula, but a short formula also exists, which is D1 minus sigma root T. Okay. So if you have calculated D1 already, then you can use this relationship to find D2 value. Okay. Now what is ND1? ND1, ND2 is nothing but the CDF values from the normal distribution table, standard normal distribution table, precisely. Okay. So ND1, if let's say your D1 is 0.12. So you open the standard normal table, you look at 0.12, what is the corresponding CDF value? Okay. That gives you ND1. Usually in the examination, you will find that these values are already given. So you can carry out the calculation. Now, from the examination perspective, if you ask me, then I would say there will be questions where they might ask you only to calculate D1 or D2. First thing. Second, they may give you D1, D2 values and even ND1 and D2 values, and they may ask you to calculate call and put prices. Okay, so this is something that you can expect in the examination. And one more catch is here is that they will give you ND1 and ND2 values. Okay, and they will ask you to find the put option price. So that is also easy, because in put option, you take N of minus D2, which is nothing but 1 minus ND2. So remember this relationship. You have studied everything in the quantitative analysis modules. Okay, and that has already been covered. So I'll not dive into that concept, that why this, why that. Okay. So you need to remember these tricks also. They may do it sometimes. Okay. Now, if you're worst lucky, then if your luck is at the worst on that day, then possibly you will see a question where you will have to find it everything, including D1, ND1, call, everything. Okay. Next, we need to understand the implied volatility. So what is implied volatility? I hope you guys are already aware, but I'll just give you a crux here that what it is. So implied volatility is the volatility that is derived from the price of options. So you see, BSM model was actually built to find the price of the options. But in today's scenario, BSM model is more actively used to find the volatility of the options, of the implied volatility of the assets. Okay, underlying assets. Implied volatility, it's a forward-looking volatility. Okay, which tells us market expectations about the future. So if let's say people are expecting that in the future the price will be increasing, so their call option price will increase, thereby leading to change in the implied volatility. Okay, so the thing is, you can apply BSM formula if you know stock price, strike price, risk-free rate, volatility, and time period. 5 parameters need to be known, including volatility. But nowadays, what is happening? People are using BSM formula to find the implied volatility. They know that they take the option price from the market. The objective is to find the implied volatility. So it's kind of like a chicken and egg problem. And we know a circle has no ending or no start. So it's not a question to discuss. But the important thing to understand here is that usually we expect that for a stock, volatility will stay constant. Okay. So no matter what so on the x-axis here, let's say you have the ratio of K by S naught. Okay. Or strike price by asset price. To keep it simple, let's say it's only asset price because for a given option, K is fixed. Okay. Or let's say we are talking about a fixed strike price. So implied volatility should look like this, a straight line parallel to the x-axis. Okay. But in reality, things are slightly different. In practice, for example, here for an FX options, the implied volatility curve is shown. It shows that when the options are at the money, the implied volatility is found to be lowest. And when the options are either in the money or out of the money, okay, the options are found to be, the underlying asset is found to have higher implied volatility. Okay, or the options give us higher implied volatility. Okay, for equity, the volatility smile looks like this. If the options are out of the money, implied volatility is very high. But as it moves towards at the money and finally towards in the money, the option implied volatility actually declines. Okay, so implied volatility is not constant. If you're using different options, you will get different implied volatility values. Okay, so you have to be very, very careful as to which implied volatility should be used to find the value of an option. So for that, you need to take into consideration the ratio K by S. Okay, so what is the strike price you are considering? What is the current asset price? And then for that K by S ratio, what is the implied volatility shown in the market? That implied volatility will be used to price the option. Okay, that's the takeaway. Now, if we talk about options on assets which are not non-dividend paying stocks, which are maybe some kind of dividend is being paid. So slight deviation in the formula. In case of D1, previously it was R plus sigma square by 2. Now it becomes R minus Q, where Q is the dividend yield. Okay, or the return, you can say. And simultaneously, the formula for call and put also changes. It becomes S naught e raised to the power of minus QT. Okay, so just a trick I'm telling you. Strike price is always discounted at the risk-free rate. Okay, asset is discounted at the yield or return. Yield, dividend, return, whatever it is given. Asset price, yield, return, strike price, risk-free rate. Okay, always remember that. So no matter what is given, and we know that if it's a currency pair, let's say, then we know that foreign currency risk-free rate is considered as return. So S naught will be discounted at the foreign currency risk-free rate and K will be discounted at the domestic currency risk-free rate. That's the catch here. Okay. And simultaneously, you adjust the formulas for D1 and D2. R minus Q everywhere. R minus return. If it's futures contract, then we know that for futures contract, the return is same as the risk-free rate. So that means both S naught and K will be discounted at the risk-free rate. And here it will be R minus R. Okay, because Q is replaced by R minus R. So formula reduces to ln of S naught by K plus sigma square by 2 times T divided by sigma root T. Okay, that's how the formula changes. And the same thing has been shown here. You see, foreign currency risk-free rate, discount the S naught. Here also RF is subtracted. Futures, F naught, of course, you have the futures price, not the S naught. Okay, so F naught is discounted at risk-free rate. K is discounted at risk-free rate because risk-free rate is the return. Okay, on the futures contract. And here, if you look at It's sigma square by 2 times t. Slight variation. It's just the same thing. Sigma square times t by 2. I can also write it as sigma square by 2 times t. Both are the same thing. Okay. So just a slight variation and you get all the formulas. Okay. Now, the catch is in the case of discrete dividends. If you have discrete dividends within the life of the option, before the option is expiring, if you are getting a dividend, then that dividend has to be adjusted into the price. And for that, BSM formula can be manipulated slightly and it works. So for example, here in this case, what you will do, you just replace wherever you have S naught, you replace S naught with S naught minus PV of D. Rest everything else is same. Okay, S naught minus PV of D. In every calculation, wherever you have S naught, replace it with S naught minus PVD, present value of discrete dividends. End of the story. Okay, now let's talk about American options. Now, as I said, there was one concept that I discussed in FMP 13, which I said I will discuss once again when I reach this chapter. So I'll tell you right now also that what it is. Okay. But first, let's understand what is the case with American options. Can we apply binomial tree method? Okay, so call options on non-dividend paying stocks, as we know, for if it is an American style call option on non-dividend paying stock, it is never optimal to exercise early. You will never exercise it. So no matter what the nodes are, okay, if it's an American style call option, the values that are taken are the backward inducted values. Okay. So for valuing American style call options only, okay, you can use BSM model formula to find the American option values. Okay, but if it's a put option, then put option have certain criteria. They may be exercised before maturity. Okay, so put options, American style put options can never be valued using BSM model. Okay, so again, I am giving you a trick here in the examination. If let's say in the exam, they ask you to find the BSM, find the American option price using binomial tree method, and let's say it's American call option. Then what you can do, just try it out, because in any case, this question is going to take time. Okay, so it's better that you use 1 or 2 minutes, apply the BSM model formula. Okay, calculate ND1, calculate ND2. Okay, find out C. Okay, and then look for the closest value there in the option, which is to that closest value. It can be higher or lower. The closest value you have to look for. There is a 99% chance that that option will be your answer. Okay. However, if let's say you are not sure enough about that, then of course you can go for the traditional method, that is building the complete tree and finding out the payoff. And it is only for American style call options. Okay. Now in FMP 13, when we were discussing about put call parity for American style options, there I told you guys that it's not a direct put call parity. We have a relationship, an inequality for the difference between call and put price. Okay. And I said that usually in the exam, if you are tested on this concept, they will give you the call price, but not the put price. And they will ask you to find the price range for put options, not call. What is the practical reason for that? The practical reason is this. You cannot value a call American put option using BSM model. Okay. So the thing is, if you have the call option price on most of the scenarios in practice also, if I say American call option price, standard American call option prices can be calculated using BSM formula, but not the put option price. So for put option, you always get a range of values within which it can lie. So once you have calculated the call option price, you can get the range within which the put option prices will lie. And that has some use, practical use. And that is the reason why most of the time you will only find that the price range of put option is asked based on American call option put call parity. Okay, so that's the case here. Now, if let's say you have American put options or American call options other than non-dividend paying stock, if let's say you have an American call option, but it's not a non-dividend paying stock, rather than let's say it's an index or currency or futures, whatever, then also you are not allowed to use BSM model. Okay, you have to use binomial tree model. Okay, for American call options on underlying assets which pay dividend, any kind of dividend. Okay, it can be of any form. So that's the crux of it. And let me tell you one more thing, final, before we conclude this chapter. And that is, if let's say you have a European option that you are valuing using binomial tree and using BSM. One might ask that what's the difference between these two? Well, practically, there will be slight difference. Okay. And this difference can actually be reduced to zero. I would not say zero, but it can be minimized to a very lower value. Okay. Because if you value a call option using using binomial tree, European style call option using binomial tree and using BSM model, there will be slight difference in the prices always. Okay. And this difference arises because binomial tree by Black-Scholes-Merton model, BSM model assumes that stock price change, that the time period delta T that we had there for binomial tree, delta T is infinitesimally small or it tends to zero. That is the underlying crux of BSM model. Okay, you are earning return on a continuous basis. Okay, in case of binomial tree method, delta T is somewhat large, maybe 1 day, 1 month, one. So that's the reason for the difference. Now, if you increase the number of steps in the binomial tree, the accuracy of the price estimation will increase of binomial, and it will become more and more and more closer to the BSM price that you have calculated. Okay, so if let's say you are using 500 step tree, okay, for a three-month call option. Okay, so in this case, the price that you receive from that binomial tree and the price that you calculate using BSM model will be almost same. Okay, there will be difference maybe at the 10th or 12th decimal place, but for up to 7, 8 decimal places, 9, 10 decimal places, the values will be same. Okay. However, the catch is in practice, if it is a European style option, why would anybody take the um, uh, binomial tree method to calculate the option price? They will directly use BSM model. But if it's American option, then most of the time people do apply binomial tree method. Okay. And if it's a non-dividend paying American call option, then also BSM can be applied, or else do not apply BSM on American. Okay, only one American option is there on which you can apply BSM. Okay, that is American call option on non-dividend paying stock. That's it. Okay, so with this we have concluded the chapter. Now you see only one chapter is left, and that is VRM 16. Okay. Divesh, not necessarily. It totally depends on the scenario. Sometimes, again, I said not necessarily. It can be sometimes high, sometimes low. So for example, I'll tell you, like maybe at 50 step, you will see the, if let's say you use a 50 step binomial tree, you find the price to be 2.714. Let's say actual is 2.68. Okay, actual is 2.68, for example. If you use 50 step, you find 2.714. But if let's say you use 70 step, it might come out to 2.64. Rather, it should be 68, right? It turns out to 2.66, for example. So number of steps can lead to different values. Sometimes it can be a little bit higher, sometimes it can be a little bit lower. But as you increase the number of steps, the variability in the price will decline very sharply. And for most of the time, it will be very, very close. Okay, so that's the thing that happens. Because at the end of the day, it's an estimate. Okay, yeah. So now to the class, now only one chapter is left. So do you guys want to take a break, or should we complete that chapter? Come on, quickly tell me in the chat. Do you guys want to have a 10-15 minutes break? Because it's like 3 chapters we have studied. So I don't want you guys to get overboard. Okay. Okay. No, you see, I'll not give a 5-minute break. If I'm giving you a break, it should be sufficient enough so that you are able to relax your mind, at least for a while. Okay. So it will be a 15-minute break if I give. So come on, quickly, guys, tell me if you guys want a break or should we continue? Everyone, I'm waiting for your replies. Okay, so a lot of candidates are saying continue. So let's continue the session. So just give me a minute. I'll share the next chapter. Yes, is the screen visible? Can you please confirm? The Greeks. Okay, fine. So let's start the session. This is the final chapter of today's discussion, and this actually concludes the discussion on options altogether. Now you see, once again, I would say that this chapter is very closely related to FMP 13 that we have studied. Okay, so I'll give you references also time and again. So, and also this is not a very lengthy chapter, only some formulas are there and you just need to understand the relationships and hedging. Okay, so that's what I'll explain. I have a separate sheet explaining the hedging and all. Okay, so don't worry. Now, let's move forward and let's see the introduction. So the Greek letters which are used basically to name these risk measures, and that's why these risk measures are called simply the Greeks. Okay, and they give us information about the different types of risk arising from different types of parameters that are under consideration. Okay, and probably are for Greeks are risk measures which measure the risk arising due to changing underlying value or changing volatility or changing interest rates or dividends. Okay, risk-free rates or dividends. There is one more thing, time to maturity. But as I said, there is no uncertainty about the passage of time. So it's virtually not a risk. It's technically not a risk actually. Okay. So people are less concerned about changing time. They are more concerned about volatility and underlying value. Okay. And sometimes dividends. So first Greek that we are going to understand is delta, and delta is basically a risk measure that tells us what will be the change in the price of the derivative if the underlying price, if the value of the underlying changes by certain amount. So roughly you can say that delta is nothing but delta F, which is change in the value of the derivative divided by the change in the value of the underlying asset. Okay. However, when it comes to the actual risk measure delta, gamma, vega calculation, there are specific formulas, and these formulas are like this. For call option, delta is given as n d1. Now we already know what is d1 in the previous chapter. Ln of s naught by k plus sigma plus r minus sigma square by 2t by sigma root t. Okay, that's d1. So you just take the CDF of that standard normal CDF for that d1, that gives you the delta of call. For delta put, it is n d1 minus 1. Alternatively, you can say delta call minus 1. And d1 is nothing but delta call. So it can also be said that delta put is nothing but delta call minus 1. Okay. And d1 we have already discussed in the previous chapter, that how it is calculated. Next, what we have is vega. Vega gives us the change in the value of the derivative if there is a change in the underlying assets volatility. Okay, and this volatility, when I say, is implied volatility. Always understand, it's not the standard deviation that we have studied so far. Okay, it's the implied volatility. Okay, so volatility can be is of as of now, for you guys, I can say volatility is of two types. One way to measure volatility is standard deviation. Another way to measure volatility is implied volatility. They both have their own advantages and disadvantages. The biggest advantage of using implied volatility is that implied volatility is a forward-looking volatility. Okay, but standard deviation is a backward-looking volatility. Okay, so that's the difference between implied and not. And here, when I say volatility in case of options, we are talking about implied always, not the standard deviation. Okay. Now, the formula to calculate vega is given as S naught square root T n dash D1. N dash D1 is nothing but the PDF, standard normal PDF. Okay. And of course, you know how to calculate D1. And here this X is replaced with D1. Okay, that's the thing. Okay, X is simply replaced with D1. Now, from the examination perspective, I can say sometimes they will ask you to calculate vega also. Okay, so be prepared, and that's why I am discussing the formula. Whatever is important, I am discussing. Actually, three formulas are important at max. That is delta, gamma, vega. Delta, I have already said, it is ND1, the most basic, most easy. Okay, and these are all for non-dividend paying stock. If it's a dividend paying stock, then there are slight variations, but again, there is very less chance that they will directly ask you to calculate the risk measures. In fact, from this chapter, the objective is the focus is more on, I would say, hedging. Okay, like identifying the hedges that are needed to make the portfolio delta, vega, gamma neutral, things like that. Okay. Next, we have gamma. Gamma actually measures the change in delta itself if the underlying asset price changes. Okay, now here I would like to give you an analogy from bonds. So in bonds, we have studied duration and convexity. Okay, I would not say they are same, and that's why I said it's an analogy. Okay, it's not exactly the same thing. Duration, what it does, duration tells us the linear change in the bond price if the underlying yield changes. Okay. Delta tells us the linear change in the option price, for example, if the underlying asset price changes. Okay, that's the delta. In the case of convexity, we had convexity measures the change in the duration if the underlying yield changes. That means how the duration itself will change if the yield changes. Similarly, gamma measures how the delta will change itself if the underlying asset price changes. Okay, and if you apply Taylor approximation on delta and gamma also, the relationship is exactly the same. For example, in the case of bonds, if you had to calculate delta B, it was minus of dB delta y plus 1 by 2 CB delta y square. Okay, the same is true for this scenario also. In case of derivative, if you have to use Taylor approximation to find the change in the value of the derivative using delta and gamma, it will be delta times delta times change in the stock price plus 1 by 2 gamma times change in the stock price squared. Okay, so I give this analogy just to make you clear that if you only remember just one of the formulas, okay, you are covered for both. In fact, this formula is discussed in market risk chapters, that is VRM 1, 2, and 3. We'll again get back to that, okay, because VRM is yet to be discussed as of now. Now, if let's say, again, as I said, delta assumes a linear relationship between the option price and the stock price, but in reality, it's non-linear. And actually, gamma is that adjustment of error which delta is making. Similarly, similar to that, convexity was also an adjustment of error that duration was making. Okay, so gamma is the adjustment of error that delta is making. Okay, now calculation for gamma is quite simple. N dash d1 by s naught sigma root t. Again, n dash d1 is same, the PDF of a standard normal. Okay, which is 1 by square root of 2 pi e raised to the power of minus x square by 2. Okay, it's very simple formula. You can memorize it. Even I remember this formula, although I rarely remember anything, especially when I talk about the formulas. It's not about the concepts, about the formulas. I usually forget the formulas quite easily. Okay, now gamma and vega, as we discussed, vega previously and gamma now, are very similar. Okay, in fact, I'll show you the graph in a while, just after this slide, okay, about all these risk measures. But there is slight difference. In fact, the graphs of gamma and vega are also similar, but there is one very stark difference, that if the time to maturity increases, the curve vega also increases. But if the time to maturity, on the other hand, gamma actually decreases. What it means, I'll show you in 3 dimensions, so don't worry. Just give me a minute. I'll just share the Excel file with you guys. Okay, I will explain a lot of things there also. So can you please tell if the Excel screen is visible? Okay. So now let's talk about delta first. So here you see this blue line actually represents the delta of call and red line actually represents the delta of put. Okay, if it is on the same underlying asset and only the stock prices are changing, none other thing is changing. Okay, so for example, volatility, risk-free rate, time, everything is fixed. Only the stock price is changing. Then the curves look like this. Okay, when the option is at the money, you will find that delta call is 0.5, around 0.5. And when the put option is at the money, the delta put is minus 0.5. Okay, and always remember, at any point of time, the difference between the delta call and delta put with same specifications, I'm saying again, same specifications, okay, is 1. There will always be a difference of 1. Here you see, I have calculated the difference also at the bottom line. It says 1 at all points. And this is difference of delta call minus delta put. And it's easy to understand also, because if you remember the formula I was discussing in the slides, it was written delta put equals to n d1 minus 1. And n d1 was nothing but delta call. So it was also written that delta put is nothing but delta call minus 1. Now, if you are taking the difference between delta call and delta put, so it will become delta call minus delta put equals to 1. Okay, so that will be a final result. And that's something which is visible from the graph also. And these are actual results, actual numbers. Okay, these are not some hypothetical scenario. I looked into the data, I found out the stocks, I selected them, and then I did the calculation. Okay, so these are real time, like they happen in practice also. These things happen in practice as well. Okay, now let's talk about delta hedging, because that's more important. Once you have understood the delta, you need to understand the delta hedging. So here what we have is that you have a portfolio today which consists of short calls, and it is 1 million calls which you have shorted. Okay, ignore the portfolio value for now. Okay, it's nothing. Just let me do this. Okay. So you have this short call. Okay. Now, strike price for this call option is 41. Volatility is 0.22 or 22%. Risk-free rate is 4%. Time to maturity is 0.25. That is 3 months. Stock price today is 42. Okay. You find the call option price is 2.6015. So of course, if you want to find the value of the portfolio, you can multiply 1 million with 2.6055. But that's not relevant. For what relevant for us is actually the delta of call. It is 0.6424. Okay, it's 0.6424. So now I need to find, and I need to know what is the delta of my portfolio. So for one call, delta is 0.6424. So for 1 million calls, what is the delta? It's simply 1 million times 0.6424. Now the catch here is that this call delta that is written, we say that call delta is positive. Okay, when I say positive, it means for long position. Okay, if you're long on call, delta is positive. If you're short on call, delta becomes negative. Now here the portfolio is short calls. Okay, so you see, when I say portfolio delta, it is minus of 642,436. Okay, this is my delta of portfolio. Now, when I'm trying to hedge delta, I can hedge it using the underlying asset itself. Okay, for delta hedging, other derivatives are not necessary. But for gamma and vega, you can't use underlying stock, because for underlying stock, gamma and vega is 0. Okay, you can't use them. So you'll have to use a different derivative on the same asset. Okay, so for stock, delta is 1. I have to find the hedge. Now, hedge is pretty simple. You see, what our objective is that currently I have certain exposure. I need to add something in my portfolio so that my exposure becomes 0. Okay, so that my exposure becomes 0. So I'll just try to show you. I don't have my pen tablet with me right now, but I'll just try to show you. Okay, so my exposure is let's say 6, 4, 2, 4, 6. Okay, and this is in negative. This is my existing exposure. Now I need to add something in my portfolio so that my net exposure becomes 0. Okay, so this is my hedging equation, you can say. Now here I have the stock. One stock has a delta of 1. So how many stocks do I need? Let's say it is X. Okay, let's say this is X. So I will write X times 1. X times 1. Okay, this should be equal to 0. Now in this case, it is pretty easy to solve because X times 1 is X. So X is nothing but you will transpose it to the RHS and it will become 64,246. So number of stocks will be 64,246. Now the benefit of using this equation, hedging equation, is that if you get a positive number as your final result, okay, if you get the positive number, it means you have to go long. And if you get a negative number, it means you have to go short. Okay, and that's why I always recommend candidates to use the hedging equation rather than doing such calculations where you'll have to separately add plus or minus sign after you get the answer. Okay, in this case, you are not required to add anything extra from your side. Okay, and you get the result. Now, this is what you do today. Now, as I said, stock price can change over time and thereby leading to a change in the delta also. So here you can see stock price changes from 42 to 38. Okay, and the call delta decreases to 0.2929. Okay, now my exposure is minus 292920. Okay, this is my exposure, current exposure. Okay, so what is the hedge that I need today after a week? Okay, so the hedge needed is, of course, I use this hedge equation. I find that I need to go long in 292920 stocks. That means 292,920 stocks. Okay, but the problem is 1 week ago, I went long in 642,436 stocks. So what I have to do today is that I need to change the hedge. Okay. And in essence, my hedging position is actually reduced. Okay. My exposure has actually reduced. So I need to reduce my position. So it has to be change in hedge is basically reduction of the difference between these two, that is 349,515 stocks. Now, why I'm showing this to you guys, I'll tell you. Very simple reason that in the examination, what you will see, there is first scenario where they will ask you to find the hedging, find the number of stocks needed to hedge. Okay, which is like this. Okay. Now there will be second scenario where they may give you a situation that, okay, this is the uh, scenario. So a hedge is initiated. Okay. And currently, in order to make the portfolio delta neutral, the stocks needed is 64,236. Okay. So that has been taken. Now, after a week, what happens? Delta becomes 0.2929. Okay. Now, how many shares? Now, what should be the hedge position? Okay. What should be the hedge position? If that is the question. So hedge position should be long in 292,920 stocks. And if they ask how many stocks, or if they ask that how the hedge position should change over this 1 week. Okay. So in that case, this will become your answer, not this. Okay. Because this is your hedge. After a week, your hedge has to comprise of 292,920 long position in stocks. But how it will change over 1 week? So this will lead to a short sale, or a shorting off, or a closing off, or a selling off, whatever you call it. Closing off 349,550 positions. Existing positions has to be closed out. Okay. So that's something that you need to be very careful during the examination, that what the question is actually asking. Next, we have the Vega. Now the curve for Vega, it looks like an umbrella. Okay. Pretty simple. Let's talk about Gamma. You see, it also looks like umbrella. Okay. So both have the same curve, but there is a slight difference in the Vega and Gamma behavior, and it is clear from here. So here what we have on the x-axis, we have the different stock prices on both the graphs. Okay. On the x-axis, we have the stock prices. On y-axis, the Vega and Gamma values are, so that's ignored. Okay. On the z-axis, we have the maturities, different maturities on the z-axis. Now you look for Vega, what is happening? When the maturity is less, it is used umbrella shape, there is no doubt. Okay. But the peak is not too high. If I go back, you see the last line. Okay. The last one. I'll just use a pointer if possible. Okay. See the last line that you have. It is way too high. So when I said that Vega increases as the time to maturity increases, was this. In fact, if the option is out of the money or deep in the money, then also Vega is small. But just compare this scenario with this scenario, last one. It is still higher. And that's why it was said that as the time to maturity increases, Vega increases overall. Okay. But if you talk about Gamma, the first curve is very peaked. But you see the last curve, it is almost flat. Almost flat. Okay, which means that if the time to maturity increases, Gamma decreases overall. Okay, so that's the takeaway from here. Now, let's talk about Vega hedging and Gamma hedging quickly, and then we'll be able to conclude the session. Okay, so in case of Vega and Delta hedging, usually in the question from the exam point of view, you will see that it is already given that the position is delta neutral. Okay, position is delta neutral, but they have certain Gamma exposure. Now here Gamma is given, Vega is given 9.1424. Vega is given. Okay. And formula to calculate Vega for both call and put option is exactly the same. They have the single formula, not unlike what we had for delta. Okay. For delta, theta, and rho, we have different formulas for call and put. But for Vega and Gamma, we have the same formula, single formula. Okay. So here you have short calls. Okay. And these short calls, we have shorted 1000 calls, and you have delta also somewhere, but as of now, it is delta neutral. The Vega of one call option is 9.1424. You see, now as I said, Vega is 9.1.24. Naturally, it means long position. Okay, be it call or put, long position, naturally. Now, since I have shorted calls, 1000 calls, so my actual Vega per call is minus 9.1424. Okay. So when it comes to hedging Vega, I can't use underlying asset. For underlying asset, Vega is 0. So I'll have to naturally use a different derivative on the same asset. Okay. And let's say I use a hedging option, which has a delta of 60, which has a Vega of 16.1613. And it also has a delta. This option also has its own delta, right? You see ND1. This is the delta, minus 0.69. And this is the delta of the hedging option. Okay, the option that I'm using to hedge the position. It is 0.7758. Okay, this is my hedging instrument. Now, first I need to find out what is my portfolio Vega. So my portfolio Vega is minus 9.142 or 9,142 roughly. Okay. So now I want to find out how much options, hedging options should I use? Okay. So I'll just show you here in a very simple way. I'll just write it down for you guys. Okay. So here, what I have to do is I have my existing Vega as minus 9142.41398. Okay, this is my existing Vega portfolio. Now I want to add hedging instrument. Okay, let's say I have X unit of hedging instruments. So that, and each of these options have a Vega of 16.1613. So it will be multiplied with 16.1613. Okay. Now, when I add this position into my portfolio, my net position is 0 Vega. Okay, my net position is 0 Vega. Now, it's a linear equation in single variable. I can easily solve it. And when I solve it, I get that I need to go, I get a number 565.69. Okay, so let's say approximately it is 566. Okay, now since it's a positive number, that means I need to go long in 566 unit of hedging option. Okay, now the moment I go long in hedging option, it has one more repercussion. Okay, I add delta. One option had a delta of 0.7758. Okay, I have taken into account 566 options. So this is my new delta introduced. So here you see it is written also delta introduced 438.86. Now it is quite easy to manage the delta. Okay, how we can use the underlying asset? So my delta introduced delta is 438.86, let's say, or 87 for the sake of simplicity. Okay, I want to add something in my portfolio, add some stocks in my portfolio so that my delta exposure becomes 0. Now just solve it. Okay, you just solve it. X equal to 0 minus 438.87, which is nothing but 438.8, sorry, minus 438.87, 438.87. So it means you roughly it will be 439 shares, and minus sign means you need to go short. Go short in 439 shares. So that's how Vega hedging is done. Now the problem comes when you have Vega and delta. You have to hedge both of them. Okay, when you have to hedge both of them, Vega and delta, then problem comes. Now you see the logic is very simple. If you have to hedge one risk measure, for example, in the previous two scenarios, in the case of delta hedging or only Vega hedging, we had to use only one. We had to hedge only one exposure, that was Vega. Okay, so for hedging Vega, if only one exposure was there, I was using one hedging instrument. But if let's say I have to hedge two risk measures, for example, Vega and Gamma, then I'll have to use two risk measures, two hedging instruments. If I have to hedge three risk measures, I'll have to use three hedging instruments. Okay, that's how things work. So here I have to hedge Gamma as well as Vega. Gamma as well as Vega. Okay. So, and also delta. So first I'll start with delta because delta is easiest to hedge. I have to use just the stock, end of the story. Okay, and it has nothing to, it will never impact my Gamma or Vega because stocks have gamma and vega of 0. So even if I add them into my portfolio, I'm not adding any extra gamma or vega. So I can consider stock, I can consider hedging for delta separately and then hedging for gamma and vega separately. Okay. So this understanding also needs to be there. Otherwise, what you will do, you guys will take into consideration, okay, delta is also to be hedged. So I require 3 hedging instruments in that case. Okay. But that's the scenario when similar hedging instruments have to be used. Here, to hedge delta, a entirely different asset has to be used. And to hedge gamma and vega, entirely different assets have to be used. But for gamma and vega, the assets have to be similar. Okay, so that's why. Now, first I find the portfolio, it is minus 558, hedge is plus 558. So I go long in 558 shares. My portfolio becomes delta neutral. The moment I take long position in 558 shares, I become delta neutral. But I still have gamma and vega exposures. Now you see, again, these are negative numbers. Why? Because it is short call. Okay, because it is short call. That's why these are negative numbers. Now, since 2 risk measures are there, I need 2 hedging instruments, 1 and 2. They have vega of 2.54, 0.054, 4.51, and 0.153. And each of them have delta of 0.2 and 0.4. Now here, although portfolio values are written 9.8767 and 71, so that's for a different reason, because here I have used matrix multiplication to find the values of hedging position. Okay. You guys are in practice in the examination, Excel is not required. You guys can't do matrix multiplication. So this is not at all needed. In your case, what you have to do is just build a hedge equation. Okay, just build a hedge equation. I'll show. Just a minute. Okay, just build a hedge equation. So let's say you buy X1 for hedge 1, for option 1, sorry, and X2 units of option 2. Now let's start with vega. So vega for option 1 is 2.54 and for option 2 is 4.51. Okay, you can name them X and Y also, because linear equations are usually more understood in that case, but still. Now, first we will neutralize vega. If I want to neutralize vega, it will be my existing vega is how much? My existing vega is minus 9867.95, for instance. Okay. Then I add 2 hedging instruments plus 2.54 times X1 plus it will be 4.51 times X2. Okay. And this should be equal to 0. When I add these 2 positions, my vega exposure will become 0. I will solve it. Okay. Finally, since there are two variables, I need one more equation. So now I will do for gamma. Okay. I do for gamma. It will be, my existing gamma is minus 71.77. Okay. Then I add option 1, that is 0.054 X1. And then I add 0.153 instrument 2. And when I do this, again, my net portfolio exposure becomes, net gamma exposure becomes 0. Now I can solve for these 2 equations for X1 and X2. And when you solve it, you will get these 2 numbers. You need to 8175 plus 8175 for option 1, or 76, I would say, and minus 2416 for option 2. So it means go long in 8175 units of option 1 and short in 2416 units of option 2. Now, the moment you do this, you include delta into the portfolio, because each of these had their own deltas. So first you need to calculate the delta then. Okay. So what will be the delta? It will be 0.2 times the number of shares of first one, that is 8175.6831. Okay. Plus second one had 0.4 times minus 2416.47002. Okay, now you need to consider one more thing, that take the sign with the numbers as well. Okay, positions as well. Don't forget the sign. Sign has to be taken always. Okay, now when you solve it, you will get 668.5482. Okay, for delta neutrality, you need to short these many shares. Okay, you need to short these many shares and you short them. Okay, now if you want to find out exact number of shares that you have in your portfolio to make the overall portfolio delta neutral. So you see, you already had 558 shares long. Now you are 668 shares short. So your net stock position is simply equal to this plus this. That is short on 110 shares, net position, net stock position. Okay, this is your final position. Long in 8,176 units of option 1, short in 2,416 units of option 2, and short in 110.5 units, or you can say 111 units of underlying stock. You become delta vega gamma neutral. Okay, so that's the crux of this chapter, and this is the most important aspect, and that's why I took time to explain these concepts to you guys. Okay, so now let's get back to the slides. There are only final touch that is left. Okay, so delta vega gamma is done. Other European options, if the rate is Q, there can be for stock indices, currencies, and futures. We have been doing it in the last two chapters. If it is indices, we replace, we just subtract Q. Options, Q is replaced with the foreign risk-free rate. Futures, Q is equal to R. Okay, you just need to remember these things and then manipulate the formula. D1 and D2 formula manipulation, we have already seen it. Okay, now how these formula will change if we have a dividend yield or if we have anything extra. Okay, foreign return, or let's say futures, or let's say anything. Okay, so here it will be e raised to the power of minus qt. Delta formulas for put and call, vega formulas, everywhere you will see e raised to the power of minus qt gets added, multiplied, not added, multiplied everywhere. Okay, for non-dividend paying stock, it was ND1. Now it is e raised to the power of minus qt, ND1. Okay, for gamma, if you see, it was n dash d1 by s naught sigma root t. Now it is n dash d1 times e raised to the power of minus qt whole divided by s naught sigma root t. Okay, so that's the only difference. Only e raised to the power of minus qt comes everywhere. Okay, that's the basic difference. Okay, so theta and rho, just forget them. Formulas are also very complex and they're not going to ask these in the examination. Okay, so delta, vega, gamma, they were important. Hedging was important. Some formulas were important. I've already explained that. And with this, we have completed the final chapter of our discussion today. That was VRM 16. So I hope you guys were able to gain something from this. You guys able to revise properly the concepts that you have studied so far. Okay, so all the very best for your examination. Let's meet in the next class. Till then, everybody have a good day, prepare hard, and just practice a lot of questions. You have studied, it is fresh in your mind. Immediately after the class, maybe after a break or so, practice the questions. Divesh, for that, again, I would say message us on Telegram. Okay, they will tell you the class schedule and everything. Okay. Okay. Yeah, Irene asked to go. So most welcome, guys. I really enjoyed. I hope you guys also enjoyed the session. So let's meet till next time. Have a good day, everybody.